were, most painful
I look
calls.
forward to the book, Tom, about you cutting them some slack.
No, the book's called Joyous Slaughter.
Is that right?
Data dependency.
Futures down. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City this morning. Good morning on TV and radio. This is Bloomberg Surveillance, and here is your price action. Just a little bit softer on the S&P, down 0.2% on the Nasdaq 100, down around about 1/3 of 1%. Max Kettner over at HSBC is bearish, and it becomes even more bearish as the market bounces off the lows of mid-June. He is expecting an impending, sharp growth slowdown. For that reason, underweight stocks, underweight high yield, and overweight sovereigns. Let's talk about that. Treasuries, 2s, 10s and 30s. Your 10-year yield over the last couple of days just coming in a little bit. In again today by about a basis point or so to 316.41 after having a sniff at 325 again in the last 24 hours. The data, Tom, not great. We talked about the Dallas Fed manufacturing data, the Richmond Fed manufacturing data, the consumer confidence yesterday, last week, the PMIs. Looking ahead to an ISM a little bit later this week.
No question about that. With GDP, we look at a third look at first quarter today, I believe it is, with a negative statistic there. John, George Saravelis moments ago does a fabulous publication on the linkage of dollar to recession guessing. And he makes clear there's no correlation, there's no guesstimate you can do, but the Deutsche Bank bet is a next large dollar move after we go into the recession is weaker dollar off the recovery out of the bottom of a recession.
And Morgan Stanley thinks that we'll see that recession in Europe pretty soon. So let's talk about Europe just briefly. Take a look at the German curve, 2s, 10s, have a look at euro dollar as well. Yields came in Germany by a lot more than 1 basis point early this morning because the regional CPI prints, the breakdown we got from region to region in Germany, were coming in a whole lot softer. Then Spanish inflation shot higher into double digits. So look out for the German headline print in around about 90 minutes from now, going into the Eurozone headline number this Friday, with euro dollar, Tom, basically unchanged on a session at 105.25.
Yeah, the 105 thing is interesting, John. I don't have a strong feeling there. You know, there's many other people looking for stronger dollar. Euro gives his way as well. But for Mr. Bailey, I'm sorry. The fragility of pound sterling on a tick-by-tick basis is tangible. It acts almost like BitDog.
Tom, I've talked about this a few times in the last day or so. This panel is really interesting. If there's some tension between the three of them that I think we can kind of tease out, it's got to be over the FX channel. Keep saying this. Chairman Powell has a strong currency. President Lagarde would like one. And I think that right now Governor Bailey really needs one.
120, where am I on that? Excuse me, 121.84 down from the 122 level. Weaker pound sterling. Are we done?
We're done. We were done about 60 seconds ago. I appreciate that, Tom.
That's a very good data check.
Get bonus round in 60 minutes.
Steve Chiverone is taking notes, head of multi-asset solutions, Federated Hermes right now. Steve, what have you changed here? I mean, the dynamics now, the nudginess, we have this panel today, but really the economic data tomorrow. How has Federated tweaked the 60-40 allocation?
Significantly. You know, we've been sellers really since last September. And we took the opportunity with last week's rally. You know, growth had popped about 10%, and we reduced. So we're at 1% overweight equities, which is, you know, 61% equities right now, which is the lowest overweight, Tom, that we've had really since 2008, 2009. As you know, along with Steve Auth and Phil Orlando, we've been one of the most bullish shops on the street really for the last decade plus. But we're as low in our allocation equities as we've been. And we mirror that on the fixed income side. We are underweight almost every major category of credit. In fact, not almost every major category of credit. And that's really only the third time in the last 15 years.
Help our radio and TV audiences that are saying, okay, underweight, translate that. Does that mean go to cash?
It does, to a certain extent. So we've been, you know, our neutral allocation to cash in that 60-40 is roughly 3%. You know, we're sitting at 8, which is, you know, darn near 3 times our normal cash weight. So almost a triple levered cash fund, if you will.
There we go. Love it.
But I think, you know, there's going to be a time to buy longer dated treasuries as the recession, which we think is more and more likely, comes into view. The problem is, I think the rally of the last couple of weeks in treasuries is still premature. I still think you're going to have upside surprises to inflation, a Fed that's hawkish, and a 10-year that ultimately moves back to that 3.5% rate. So we would look to add on treasuries as we sell off more, because I think you're going to want those longer dated treasuries when you get into kind of worse growth periods. But right now, we think cash is king.
Steve, let's take a step back and understand the framing of your bearishness and put on your Federal Reserve thuggish hat in terms of commentating. Steve, you said before you came on that you think that they're in the midst of the biggest policy error going back to the 1930s. What exactly is their policy error?
Yeah, I mean, you know, to Tom's point, I think it's very understandable how they got there. I mean, I don't think this is malfeasance, but when you woke up in March and interest rates were 0, inflation was 8%, and the Fed was still buying bonds, I don't care how you got there. That's policy error, and that has now forced them into a position right now where they're hiking aggressively, and they need to, into a slowing economy. And I think what they missed, and Tom, you might find this interesting. What they missed is a longer-term structural change in the economy. We were in this kind of new normal sub 2% growth, sub 2% inflation, sub 2% rate environment for a decade, new normal, if you will. And just-in-time inventories are no longer just good enough. So companies are reorienting their supply chains. Chinese working age population is set to decline 20% over the next 20 years. And the U.S. population growth is set to go from 2% growth to 8% growth over that same period. And at the same time, you've undermined the three pillars, at least for the short run, of globalization. The free movement of goods really kind of peaked with the trade war. The free movement of people peaked with COVID.
Yeah.
And the free movement of finance may have peaked with this kind of economic war with Russia. And so I think you're headed to a scenario at the other side of a recession where you have higher U.S. growth, but it's less efficient. You're going to get more inflation per unit of growth. And that's a different world.
Steve, this a lot of people would agree on, at least in the short term. But in terms of what happens next is the question. And there was a belief in the market perhaps last week that the Fed would ease off on rate hikes when they saw a dampening in some of the growth expectations and, frankly, the underlying economy. We just heard from Loretta Mester of the Cleveland Federal Reserve. She doesn't see that happening, and she still sees a Fed funds rate well over 4% when it comes to next year. Do you think the market is mispricing that? Do you think that the turmoil that will ensue from that will confirm your bearishness and the reason why you're not ready to go full throttle into longer duration yet?
Yeah, I think the market has kind of contorted itself and had complacency multiple times over the course of the last 6 months, where it's looking for peak inflation and peak Fed hawkishness. Which, and I know you guys were talking about this yesterday, but if inflation goes from 8 to 7, that's not a victory lap. You really need to get that number, down, even if it's not quite to 2, certainly, pretty darn close to it. And so I think the Fed still has a lot of work to do in order to do that, because you've got service price inflation that's operating around 8-9% on a 3-month basis, and wages are high. For that to come down, unemployment needs to rise. And I think they're going to have to go for some time.
Right.
And if they do slow, Tom, I think they're slowing because it's abundantly clear that we've got a significant decline in growth, if not an outright recession.
How fast does the employment dynamic change? Jerome Powell said we have a strong economy in his testimony 2 cups of coffee ago.
We've done a lot of work on this as part of our recession dashboard, and you can go, in fact, on average, it's a series of indicators that we look at that, there's no perfect formula to understand when a recession is coming, but there's guide frames that you can look at to try to understand. On average, you can go from the cycle low in claims to a recession within 12 months. We hit a cycle low in claims 3 months ago. So there's no historic relationship between how strong a labor market is coming in terms of how fast it can deteriorate. And so it's a fickle friend to rely solely on a strong labor force. And we may find that the excess inventory that we have this cycle was employment in certain sectors. And I think we've seen some of the tech guys already say we overhired, whether that's Amazon or Meta or some of the other folks that have said that. So I think, look, this idea that you're going to get through this by only making job openings disappear, that's a comforting thought, but I think it's ultimately going to prove to be overly optimistic.
Hey, Steve, I just want to echo something you said earlier in the interview. If people aren't familiar with your work, to hear this from you, from Steve Orth, from Phil Orlando, it's quite something. Forgive the snark, but it's like Marko Kolanovic at JP Morgan coming out this morning and going max bearish.
You used to make fun of me for my snark around that.
Steve, thank you. Steve Chevrone of Federated Hermes. Steve, thank you very much. Lisa, though, seriously.
John, that was thuggish.
To hear that from Steve Orth and Steve Chevrone is something.
They are seeing a new regime, a new paradigm, and we heard that from Steve Chevrone, which was the reason why that historical perspective was so important. They see a shift that perhaps has not been fully recognized by the Federal Reserve, or has, but just too late.
TK?
Oh, I'm just thinking, the way I look at this, every time I hear the word paradigm, folks, all my radar goes up. I don't think it's a new paradigm. I think we're coming out of a once-in-a-lifetime pandemic. The gyrations are there, and the institutions will manage this thing to some form of successful outcome. I just don't, I look at the Bramodime that's out there, and it's a new Bramodime, John.
I'm just pleased we've got the establishment view around the table with us too, Tom, because that is so establishment.
What's the establishment?
TK, that we're not in a new paradigm, that they'll
get
get through this, they'll work it out. Tom, they've made a massive mistake.
I think they were handed a horrific pandemic, and and frankly, is James Burns Murdoch at the FT says, in the last couple days, the death rate of this pandemic has crept up just a little bit.
Okay.
It's not inflammatory yet, but it's sobering to see us come off 300 deaths a day up to 350, 380 deaths.
Without casting guilt or anything, because without a doubt, it was a very complicated time. No one can deny that people thought inflation had died in the past decade, and everyone was wrong. Everyone was vastly wrong, and suddenly people were talking about, remember when people were talking about printing money and helicopter money, John? And you could just throw it out the window and it wouldn't make a difference because inflation was so dead it wouldn't get revived even by that?
I think Steve framed this really well.
Yeah, I think so too.
They were given a really tough hand.
They were.
Without a doubt. Then we all misread what would happen in 2020. Most people did anyway. But Tom, it's not about 2020. It's not even about the first 6 months of 2021. It's about the fact that we had 5, 6, 7% inflation, and this Fed kept doing QE. And they were so slow to respond to it, Tom.
Yes.
That's what we're talking about, TK.
No question.
Not the bad hand they were given.
I would suggest the real issue here is if they get to 5% inflation, then what? It's going to be extremely difficult to contain it from something in that vicinity.
Futures this morning down about 7, negative 0.2% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The pressure's building more on the European Central Bank to raise interest rates for the first time in more than a decade. Inflation in Spain has unexpectedly soared to a record 10%. That beat all estimates in a Bloomberg survey, and it dashed hopes that inflation in Spain had peaked. And the European Union is effectively heralding the end of an era of internal combustion engines. EU members have endorsed a push to eliminate carbon emissions from new cars by 2035. Environment ministers struck a deal after Italy, the home of Ferrari and Lamborghini supercars, gave up demands for a 5-year delay. The wife of Supreme Court Justice Clarence Thomas has declined the January 6th committee's request for her to testify. A lawyer for Virginia, Thomas, says that there is no sufficient basis for her to appear before the panel. Emails have indicated that her efforts to prevent Joe Biden from taking office were more extensive than previously known. Disney has given a vote of confidence to embattled CEO Bob Chapek. It's extended Chapek's contract for another 3 years. He's battled controversy and a crippling pandemic. At the same time, Chapek has spearheaded Disney's transformation into a streaming powerhouse. The entertainment giant is coming closer to overtaking the existing #1 service, Netflix. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I wouldn't be surprised, and it's actually in my forecast, that growth will slip below 2%. But it won't actually pivot down into negative territory.
That's the view from Mary Daly, the San Francisco Fed president, in an event hosted by LinkedIn. We've heard the same story from Loretta Mester, Camp 75. They're in Camp 75 for a July rate hike of 75 basis points. Heard a similar story from John Williams of the New York Fed as well, Tom, this idea that they won't go into negative territory. He's expecting growth to slow probably to 1 to 1.5%.
What's he supposed to say?
Something like that. Tom, I'm with you. They're not going to forecast a recession, are they?
No.
And then keep hiking interest rates. That's just not what they're going to do.
I thought it was very responsible. I mean, it's all there is to it. And of course, we'll drive forward the conversation with Francine Lacroix here. John, 900 now on that,
900.
Right?
The open takeover, as it should be.
Well, you know, okay. You know,
as it should be.
It's
Looking
big,
forward to
big
it.
panel. Be interesting to see. Right now, and this is your conversation to lean forward on the state of the Black Sea down to the Mediterranean. Julie Norman has a number of abilities at the University College of London Center on U.S. politics, but foundational is her academics on Arab Spring and on the terrorism of the Levant. She joins us this morning. It's off the radar of America. Congratulations to the Washington Post for writing it up a few days ago, and Bloomberg with a story here on Egypt in wheat. Julie, from Tunis to Cairo, and then all eyes back up to Odessa and the wheat coming in from Ukraine, it's not working now. How urgent is the upset in Tunisia? How urgent is the pending upset in Egypt?
Yeah, it's a good question, Tom. And I would say unrest in Tunisia in particular has been there since before this current crisis with the wheat, but that's kind of an ongoing thing. But in Egypt and in other parts of North Africa, as well as Central Africa, we are really seeing the impact of food prices going up. Obviously, we're seeing that around the world, but in some of these areas where it really is a day-to-day struggle to get food for many people, this increase in food prices is literally causing, extreme food insecurity. And at the same time, in some places, there's just not even the food coming in anymore. Wheat's obviously the big import in terms of food, but also fertilizers, which is important for actually being able to spur the agriculture locally.
Short of landing Finnish and Swedish troops on Odessa to protect the flow of wheat, that's not going to happen. What is the to-do list for President Biden and others to assist in the movement of agriculture products out of Odessa?
Yeah, so this was a big focus for the G7 over these last few days, and that was one reason why they invited several other countries to be part of that and trying to ensure that there would be some kind of movement still. But at the end of the day, it's going to be very hard for Biden or for Western powers to ensure that. As the crisis goes on, it becomes very difficult for Ukraine to be able to harvest this kind of wheat and agriculture, much less export it. And just the costs of doing so are rising so extensively. So what Biden and others are doing is really trying to look to other areas to shore up that supply while there's this just very fast decrease coming out of Ukraine and Russia.
Julia, how much political pressure do you think is on some of the NATO members not to do the spending required to really remedy some of these issues, whether it's a troop buildup, whether it's protecting NATO nations, or whether it's helping to get wheat to countries that are really in desperate need of it, especially given the economic backdrop we're looking at?
Yeah, well, it's a big issue for the U.S. and for all the countries that we're hearing talking about these tough decisions, because as we know from the U.S. context, domestic economies are hurting. Everyone is seeing prices going up. Everyone is skittish about recession. And so even this week at NATO, where we're hearing about, increasing readiness troop numbers, of really trying to push weight behind Ukraine, this idea of even increasing defense spending, it's still very tricky among many NATO members. Boris Johnson has been pushing for it here in the UK, but even in the UK, there's a lot of resistance because of those domestic pressures that people are feeling. So trying to increase spending in all of these areas while also trying to protect the domestic economy, it's just a tough balance for almost any state to hit right now.
Well, especially given some of the political pressures, since there is so much potential contention around the way that people are feeling about inflation, and it brings us back to President Biden and what he's facing at home. How much extra support in some ways has he gotten from the social issues that have really galvanized a number of Democrats versus the antipathy represented by the poll numbers based on inflation and the economic backdrop?
Yeah, so the poll numbers for Biden are just abysmal right now. And what's interesting is that's not only among Republicans and independents, but also losing favor with Democrats as well. And I think that's largely because Democrats and the whole country are feeling these effects of inflation and of the economy. And at the end of the day, that's going to be where many voters are still focusing going into November. With that said, obviously, the Supreme Court rulings, especially overturning Roe v. Wade, is something that Biden and Democrats will be leaning into to mobilize their own voters who maybe would have sat out in November, and trying to push more on that kind of issue for mobilization. But for many voters, the economy is still going to be front and center when it comes to November.
Julie Norman, thank you, of UCL. Wonderful to get your perspective on things, on US politics and global politics too. Futures negative about 1/3 of 1%. TK, Euro Swissy coming very, very close to parity this morning.
Harkening back 7 years, I believe it is, folks, to frame this for you. Strong Swiss franc is what the Swiss have lived with here. Everybody piling flows into Switzerland. That is a weaker statistic here, from a 105 plunging down 104, 1.04. John, we plunged down to 1.00 with a leg down this morning, John. That would be a shock, a 0.99 Euro Swiss.
We had that print a little bit earlier this year in the first quarter, Bramo, getting close to those levels again. What it speaks to, the difficulty in Europe, and I think the difficulties in Europe right now are pretty clear for everyone to see.
Especially in light of the 10% Spanish inflation rate. How does the ECB get in front of this when they're lagging far behind the longer it takes for them to make a decision? How much does this really push ECB President Christine Lagarde's hand, and how much do we hear about that today? We're behind. We're falling further behind. Perhaps we can front load some of these rate hikes.
Swiss National Bank already making a move, right?
Exactly.
A big move. And the ECB still to get going, Tom. The door open for many people to get going and then move maybe 50 basis points, and perhaps the door's open for that a little bit later on in the next month or so.
And John, what's sobering here is Kit Jukes writes moments ago, he'll join us here in about 2 hours pre that panel in Portugal. What's sobering here is no one really saw this SNB action coming. When is the next SNB kind of surprise? We spend all our days, John, trying to measure out and think about what the probabilities are and outcomes, and then there's this move out of the blue, which is what we got from the Swiss National Bank.
There are these two words that the ECB President Christine Lagarde keeps leaning on: Gradualism and optionality.
Yeah.
It's the second word, Tom, whether I think it opens the door more to doing something around what you described, which is something bigger. And if the inflation data leans in that direction, I don't think they're going to have much choice, given what we're hearing from other governing council members at the moment.
Yeah, I'd go in the mathiness of that. I'd go to something I think people understand, which is degrees of freedom, and they're running out of them rapidly. That's what happens with double-digit inflation, like in Spain.
The data will set the tone for that conversation. We'll get headline data from Germany in about an hour from now. Then you'll get the Eurozone print this Friday, looking for a downside surprise on Germany based on what we had with the regional numbers through this morning. We'll get to that story a little bit later. Futures negative, 0.25% this morning. Good morning to you all. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a Volcker-esque type of Fed where they are clearly focused on getting inflation down.
Core inflation, food, energy, that whole thing is no longer transitory. It's very sticky, and they're worried.
I think there has been some signs that the economy is losing a little momentum.
We actually think there's a 50-50 chance of recession in the next 12 months.
If there's a recession, it's not going to be a massive recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
A lot to look forward to this morning from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down about 0.2%. TK, we're about an hour away, 2 hours away from the central bankers in Sintra, Portugal.
A lot of moving targets here, John, and very different stories from each of them. I think they will finesse to what they do not say. And I would say more than anything, particularly looking at the currency and what we'll see with Euro Swissy here on the data check, is they're looking at foreign exchange as a litmus paper of an uncoordinated central bank system.
And looking at economic data, Tom, that's starting to weaken stateside. We saw it in the Dallas Fed manufacturing, the Richmond Fed manufacturing, the consumer confidence data too. We saw it in the PMIs last week.
Yeah, sterling gives way 121.59. I think that's a change overnight. And what I'm really watching is yen now up to 136.54. A 137 yen, John, would speak volumes to those Western central bankers.
Bramo, at this point, what we're all waiting for now is not just the economic data, but the earnings and the company-specific stories that we're said to hear from the JP Morgans of this world from, say, July 14th, when earnings season really kicks into a high gear.
And to put that July 14th into some perspective, giving you a sense of how much capital markets have slowed down, U.S. IPO volume so far this year accounts for less than 6% of what we saw in the first half of 2021. Similar story in the U.S. high-yield bond space. Capital markets have all but completely halted. How does that really speak to this lack of conviction and a lack of, frankly, forward guidance that we get from some of these earnings?
Okay, but let's compare the capital market activity that we're seeing now to what we saw at the end of 2018. Is there any comparison yet, Lisa? Are you seeing that kind of level of stress?
Actually, if you take a look, for example, at U.S. high-yield bond issuance, it's $70 billion. That's nothing compared to what it has been over recent years.
Better than zero, though.
It's
right?
better than zero. This is not ground to a halt. But given how quickly rates have been rising, there is a fear, right, that if this continues for a year, 2 years, how do companies that finance themselves at 5% rates go to 11%? 12%. And that is a very real possibility. And suddenly people are thinking, how long can this possibly go on? And how can the Fed really get ahead of that?
520 on high yield spreads, and they've stayed wide. They've stayed elevated. They just haven't come in the way that, say, equities have rallied over the last couple of weeks. We'll pick up on that with Stuart Kaiser at UBS in just a moment. Equities look like this. We're down about 1/3 of 1% on the S&P, on the NASDAQ 100, negative around about 1/3 of 1% too. 2 hours away from Chairman Powell, President Lagarde and Governor Bailey sitting down with Francine Lacqua. Looking forward to that a little bit later this morning. Yields coming in about a basis point to 315.84 on a 10-year. Euro dollar just really not giving me much this morning, Lisa. Tom, looking at Euro Swissy, Euro dollar 105.24 and unchanged on the day.
Yeah, very much looking forward to that panel. Before we get there, we do see all of the leaders of the NATO members, the NATO nations, going to Madrid for the NATO summit. We're going to hear from Jens Stoltenberg later this morning, 7:45, as well as in the 11 o'clock hour. Joe Biden also going to be there. 9 a.m., very interested to hear this panel. It is the moment of the day. It includes ECB President Christine Lagarde, Fed Chair Jay Powell, Bank of England Governor Andrew Bailey, as well as the Bank of International Settlements head Augustin Carstens, of course, moderated by our own Francine Lacqua. How much do they speak about the need to get ahead of inflation over the longer term, no matter what? How much do they speak to the prioritization of continuing to go at rate hikes, regardless of the data? This, to me, is one of the key questions at a time when people are getting increasingly concerned about inflation expectations becoming unmoored. And at 10:30 a.m., the latest read on the crude market, EIA crude oil inventory reports. This comes after we got some indications yesterday that inventories still were not building in the gasoline front, and it comes as diesel rates still remain at record highs in the United States, really pressuring everything and being an inflationary input, John, not only to people driving around, but also to companies that each transport those items.
Bramo, thank you. That's where some of the inflation has been coming from, that's for sure. Joining us now in the studio, I'm pleased to say, is Stuart Kaiser, the head of equity derivatives research at UBS. Stuart, let's start here. This was the move you've been waiting for. We bottomed on the NASDAQ on about June 16th. We bounced quite aggressively off it. You've seen that at the single name level as well on some big tech cap stocks, big mega cap stocks as well. Can you walk me through on whether we've seen the move? Whether you think it's more durable, it's got legs, and ultimately why?
Yeah, it's a great question, Jonathan. We did get a bounce off the bottom. You could argue whether that's, positioning based or actual data that's coming in. I think to make it sustainable, you're going to need to see a little bit of follow through in the inflation data, over the next couple of weeks. We get PCE on the 29th, and then you get CPI next month. So I think that's going to be the number one driver. I mean, if you really look what's happened to equity markets since late March, really, is you've had a significant decline in inflation expectations. But on the other side, you've had real rates higher and more restrictive, and you've had growth expectations kind of coming down a lot. And that sort of, back and forth between inflation and growth data has really challenged things. So I think what the market's looking for here is for inflation to stabilize a bit, and hopefully that allows, less restrictive policy to be priced into the system, which kind of takes down recession risks and on. And ultimately that's what you need for this to be more sustainable.
Stuart, as my parents taught me about foreign exchange, I was a kid and I would kill to have it. I've lost it. I had a passbook from the Union Bank of Switzerland and made money on strong Swiss franc. That was a few years ago, like 54 years ago. This is an historic moment right now. I certainly don't want you to speak for UBS on the politics of Switzerland, but I'm going to go Thatcher on you. Expect the unexpected. We are seeing shifts here. As one example, a national bank with 71 million shares of Apple going to parity moments ago on Euro Swissy. These tectonic forces that we're seeing now are extraordinary. How do you fold them into an equity belief?
Yeah, look, and that's a huge challenge to the markets. I think you're seeing that through interest rate volatility mainly. But, coming into the year, that was the issue. You had obviously decelerating growth and rising inflation, but you had a policy regime shift. And that policy regime shift was clearly going to create macro volatility. We've seen that in equities with the VIX averaging over 26 for the year. You've seen it in FX volatility and high yield volatility. So I think to me, how that's translated through to equity markets is we're not really sure where home base is, right? The risk-free rate has been so volatile. FX has been so volatile that it's hard to have a view on risk assets if risk-free assets are volatile.
You lose money.
Do you assume you lose money?
Do you assume you lose money given what you just said about volatility?
Look, I don't think you assume you lose money. I think you assume that your risk-adjusted returns are structurally lower than they have been the last couple of years. And what that's done to institutional investors is it's forced them to reduce the size of positions. As Lisa commented before, that takes down liquidity in terms of tradable assets, and that creates more volatility, which kind of, portends weaker risk-adjusted returns. So, I mean, I don't think you assume you lose money on a nominal basis, but your risk-adjusted view on that, I think, is just impeded pretty seriously.
Stuart, we started the show talking about how the Fed is just at the beginning of rate hikes, and that is from Loretta Mester, and it's also from the fact that they really haven't raised rates nearly as much as they're expected to do so. Has the market truly priced in a scenario where the Fed funds rate, as she says, is going to be at 4% by early next year, or are people retracing too much in this belief that the Fed will really ease off in the face of weakening economic data?
Lisa, I think you have to assume that was priced into the forwards and the rates market is accurately reflected in equities, with some risk premium to it. I think to your point, though, equity markets and investors in general, I think are probably hoping that, the Fed is being very aggressive to front load rate hikes. And as you mentioned before, to really talk inflation expectations and to keep those anchored. So I think you have sort of a front-loaded rate hiking cycle. You have an effort to keep expectations anchored. And, I think probably in the back of their minds, some investors are hoping that once that happens and once inflation gets a little bit more under control, then they can ease up with a little bit of that rhetoric as the year goes on. But look, I think if it's priced into the bond markets, I think you have to assume that it's largely, priced into the equity markets at this point.
Stuart, do you assume then that the leadership comes from where the leadership was in a previous decade and that ultimately not much has changed? Is that your working assumption at the moment?
Look, I think for the second half of this year, I think our view is the things that have been hurt the most by higher inflation and higher rates are ultimately going to recover a little bit. I think the trick here, Jonathan, frankly, is tech is underperformed significantly. But if you told me we are going into a recession in the next 12 months, where you want to put your money in equity markets? It's in defensives, it's in large cap, it's in strong balance sheets, and it's in high quality stocks. And frankly, that almost points you back into tech. And I think that's one thing that investors are struggling a lot with. Earlier in the year, they didn't want to own cyclicals because growth was slowing, but inflation was rising. So let's say force them into energy. Yeah. I think they're going through a similar issue right now where they don't necessarily want to be in tech because it's sold off so much. But if you're really telling me growth is going to slow materially, that is a part of the market that you typically want to own. So I think that's one of the things that's driven the lack of conviction and sort of high volatility in markets.
Stuart Kaiser at UBS. Thank you, Stu. Good to have you in the studio here in New York City, and really plays into what we heard from JP Morgan this morning. They cut the price targets on a range of names: Snap, Google, Meta, Amazon, take your pick. Went on to say, given macro pressures, we are increasingly cautious around the impact of a broader economic slowdown. Ad spending, the issue here, highly correlated with GDP. So to Stu's point, Lisa, it kind of makes sense to maybe look around tech, but certain pockets of tech, there's a very, very, very cyclical story embedded in some of those names. Well, they go on to say, though, I think this is interesting, and it's kind of the JP Morgan house view of the investment bank right now, isn't it? They think a lot of this is already priced. They think a lot of this is already priced and the bar is low. For other people, we haven't even started to price what some people fear is coming.
Especially, the bar has already been lowered so much for tech, and it's already been priced in if you think that people are going to go back into duration, right? I mean, this is sort of the other case for tech, is if you believe eventually people are going to go back into longer dated bonds and bring down those rates, and tech once again looks pretty terrific on just simply a valuation basis.
Seen some brutal calls this morning, haven't we? Can I talk about Carnival just briefly?
Please do. This is amazing.
So Morgan Stanley have come out with this call on Carnival, and I'll bring you just the snippet of it from the top of the page in the report. Listen to this. We cut our price target nearly in half. We introduce a new $0 bear case, given escalating leverage, and remain underweight. Stock's down about 7% of the pre-market.
I would go right to the leverage. I've always been amazed by the bond offerings.
A $0 bear case. I mean, that's not. Can we call that a bear case?
I could see surveillance doing it.
Do we need something more dramatic for when you start to have a $0 sort of near end of the world experience for Carnival?
Immediate annihilation.
Come on, we could do a cruise. We could strap on the old Speedo and give lectures.
That's my bear case, Tom. The idea of going on a cruise with you guys.
With a Speedo.
Futures negative a quarter of 1%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. NATO leaders are preparing to overhaul and boost the alliance's defenses in the face of Russian aggression in Europe. They want to establish a new force model that would put about 300,000 troops on high alert. President Biden says the U.S. will set up a permanent headquarters in Poland for the 5th Army Corps. NATO leaders are meeting in Madrid. Cleveland Fed President Loretta Mester says the central bank is just at the beginning of raising interest rates to control inflation. Mester told CNBC she wants to see the benchmark lending rate reach 3 to 3.5% this year and a little above 4% in 2023, even if that tips the economy into a recession, but she doesn't see that happening. A former White House aide portrayed a violent and out-of-control Donald Trump in his presidency's final weeks. Cassidy Hutchinson gave the most gripping testimony yet in a House committee's hearings on the Capitol riot. But doubt has been cast on a key element of her second-hand account. Hutchinson says she was told the president tried to grab the steering wheel of his limousine after the Secret Service refused to drive him to the Capitol on January the 6th. And Tesla's laid off about 200 workers on its autopilot team at a facility in California. Bloomberg's learned the majority of those let go were hourly workers. Last week, Tesla CEO Elon Musk had outlined plans to cut 10% of salaried employees, but said he would be increasing hourly jobs. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
Today, I'm announcing the United States will enhance our force posture in Europe and respond to the changed security environment, as well as strengthening our collective security. Together, our allies, we're going to make sure that NATO is ready to meet threats from all directions across every domain, land, air, and the sea. NATO is more needed now than it ever has been, and it's as important as it ever has been.
Significant moves from the President of the United States from New York City this morning. Good morning with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures are negative about 0.25% on the S&P. On the Nasdaq 100, we're down 1/3 of 1%. The data recently hasn't been great. You get these regional Fed manufacturing numbers, and they are not fantastic at all. You look at the PMIs last week, not brilliant. You look ahead to the ISM, and you expect maybe more of the same. Throw in consumer confidence, some weak stuff there. Yields lower by a couple of basis points again, Tom, on a 10-year, 315.47.
Yeah, it's really important. Again, we're watching Euro Swissy for an historic moment to go through parity. We're almost there right now. We'll discuss that when it happens. What's going to happen at 9 o'clock Eastern Time, Wall Street time today, is a really important panel of what will be said and what will not be said. Among others, Jerome Powell and Christine Lagarde. We are advantaged by Anne-Marie Horton in Madrid with Maria Tadeo in her Madrid, and there is a decisive difference here in the stories of Lagarde and Powell. In Spain, there is 15% unemployment amid 10% inflation, and in the United States, it is 4% unemployment amid 9% inflation. Maria, let me go to you first here. What does Lagarde not want to do today on fragmentation? What does she want to be silent on as Francine Lacroix grills her?
And Tom, 10% inflation in a country like Spain, this was a big talker today. This is really what people talk about in this country, where you get in a taxi to come to NATO. The sad reality for a lot of the Ukrainian effort here is that the people are not debating the war in Ukraine or how to help Ukraine win the war, but the fact that, of course, fuel has risen so much over the past 2 months that it is becoming a problem for a lot of people in Europe. And this is before the winter. That's when everyone here agrees things will get really difficult for the European economy. I think for Christine Lagarde, it really is about not giving too much detail away on that fragmentation tool.
Yeah.
Wait for the July summit. Again, the rate hike, there's a lot of conversation about how fast she's going to go on that front, but I think she's really want to signal now that the ECB is in a position to tame inflation, but also set up policy for 19 countries that are very different by nature, which is a very difficult job.
Emery, Joe Biden has to worry about one country on unemployment and inflation. He will fly back to the joy and the worry, the angst of moving from 4% unemployment, dare I say, higher. How will he address that in fractious Washington?
Well, he's been trying to address it while he's been abroad, making sure that all his foreign policy goals, he pivots to why it's important to the United States. This was really a big talking point at the G7 in the Bavarian Alps because, as Maria said, while these leaders are gathering together to try these efforts, to help these efforts in Ukraine, what actual people on the ground are talking about across the board are higher consumer prices. When you look at inflation, it's really groceries, it's gasoline. These are things that are worrisome. So the president really needs to make sure that while he does deliver these foreign policy messages, and we should know today was a big goal for him strategically. About a month ago, I was in the Rose Garden when he said that Finland and Sweden need to be a part of NATO. They meet every requirement and then some. This is something he was able to achieve. But is it going to be overshadowed with this list and all of these problems he has at home? The party is pushing for him to do more on women's reproductive right. Of course, after the Supreme Court struck down Roe v. Wade, then you have overshadowing a lot of the American public and media right now was the testimony yesterday out of the January 6th. And then, of course, it's inflation. These are the issues he has to face while he's also meeting with these leaders in Madrid.
Maria, how much daylight is there between world leaders when it comes to fighting inflation, given that all nations are facing a similar issue? It rhymes, but it's not the same.
It's not the same, but Lisa, if I may, actually, we now know that President Zelensky was on a video conference with NATO leaders, and he said today the top priority for you at this point should be, of course, to improve and strengthen NATO, but also to help Ukraine win. And when we say win, we mean on the battlefield. So we want to need more weapons, and it hopefully comes out of this meeting. That is the message from President Zelensky. And in terms of the economy, look, I think that for the Europeans now, it is very clear that this is going to be a very difficult winter. They worry, particularly the Germans and the Italians, if Vladimir Putin is going to cut off the gas. And for the time being, the impression that we get is that Europe feels we've done a lot to help Ukraine on the financial front. The sanctions for the time being need to stop because we really need a breather, especially because they try to get in good shape ahead of September with the storage of energy before the winter. That is really the concern for everyone here.
To the two of you, absolutely fantastic, as always. Seriously, we joke around a lot, but two of the best international correspondents in the business, Anne-Marie Hordern alongside Maria Tadeo. Thank you, guys.
If I could mention one thing, John, quickly.
Sure.
If you don't mind, if I could mention one thing. While we talk about gasoline prices at home, really dodging this president, yesterday, me and the producer, Jason Hoffman, filled up our tank before we gave back our car at the airport. It was $7.64 per gallon of gasoline in German. It's about $10 in the United Kingdom. So these inflation concerns are even more dramatic in Europe.
I was just saying how great you are, and then you cut us off. Anne-Marie, thank you, as always. Anne-Marie Hordern alongside Maria Tadeo. Lisa, I wanted to pick up on what you were talking about, because I think it's so important. When the three of these individuals sit down a little bit later this morning, when we hear from President Lagarde, Governor Bailey, and Chairman Powell, President Lagarde, in some ways, and she's been diplomatic about it, she has actually revealed the differences between what the US is experiencing and what Europe is experiencing. And she talks about the more robust fiscal response that we had in America too. And I just wonder if that's something that comes up in the conversation a little bit later.
In what tenor, though? And this, I think, will be interesting. Is it to say we don't have to go as hard as the U.S. and we can still see some sort of transitory light types of inflationary impulse that rolls over because of the lack of strength in the United States? Or is it to say that we can actually afford to spend more and we can go further? I mean, how is she going to use those differences to really draw a distinction in the policy that they then put out?
TK, your thoughts on what's about to happen in the next 90 minutes or so?
It's what they don't say. It's absolutely what they don't say. There's going to be a lot of talk, but these guys are pros. Francine's going to ask them some tough questions, and I think you're going to be shocked. And I like the idea that one of you said that fragmentation is really not going to come up in detail with Lagarde. But, I mean, Powell is just going to try to get out of this unscathed.
They're in a tough spot. Kit Dukes of SocGen's going to join us later. This is what he had to say about the Swiss National Bank. Caught between an Alp and a hard place. TK, that's the line from Kit this morning as Euro-Swiss test parity all over again for the second time this year.
I think that's a song Barry sang at the piano bar.
Is that right?
A couple of years ago.
A few drinks in.
Yeah.
I was alongside you. Futures down 8 on the S&P. We're down about 0.2%. Yields in 2 basis
it's like
points.
A Christopher Cross song.
On a 10-year.
Between an Alp and a hard place.
15. Oh, don't let me stop you. Carry on. Okay. Any drums in that?
No, I think Jeff Porcaro did the drums, actually.
Thanks. Yeah. Okay.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
You get bored of listening to the perma bears and the perma bulls, but when you hear someone who's been bullish for the best part of 10 years, say that what we're seeing from this Federal Reserve is the biggest policy mistake since the 1930s. I think it gets your attention, and that's what we heard from Steve Cheverone of Federated a little bit earlier this morning. He is very cautious on this market. Futures right now down 0.2% on the S&P. On the Nasdaq, we're down around about 1/3%. And the data so far over the last couple of days has not been great. We've talked about the Richmond Fed manufacturing number, dreadful. The Dallas Fed manufacturing number, pretty dreadful. And the Conference Board consumer confidence number, not great either. You add in the PMIs from last week, look ahead to the ISM. You can see why maybe people are starting to think about, even more so, looking at the long end of the yield curve. 2s, 10s and 30s look like this. We had a sniffer 325 yesterday. We came back in. 10s are down a basis point at 315.84. And one of those, looking at the longer end of the yield curve, may be sovereigns, developed market sovereigns to be specific. Max Kettner over at HSBC, very cautious on risk assets, 1 on high yield credit, 2 on equities, and much more constructive on what's going to happen here in bonds. Perhaps that's your view. Maybe others, Bramwell, would push back, given that this time is very, very different, isn't it? It's not just about lower growth expectations. What do you do with the inflation piece of that story as you look ahead as well?
How much is this about Fed credibility and central banks being able to get inflation under control and then overshooting perhaps and giving duration back a bit? If you take a look at longer term inflation expectations, they confirm the Max Kettner view of things because they've been coming down rapidly over the past few weeks.
We'll hear from those central bankers in around about 90 minutes from now, sitting down with Francine Lacqua, Chairman Powell, President Lagarde, and Governor Bailey. And this is going to be important, particularly for Europe. Take a look at this. We'll finish on European bonds and take a look at the German curve, say 2s and 10s. Your 2-year right now comes in a couple of basis points, down 3. And Tom, that's off the back of these regional German CPI prints that were a bit softer than expected. But as we talked about with Maria and Anne-Marie, Spanish inflation into double figures puts the ECB in a little bit of a tough spot.
Yeah,
going into their next meeting.
And the fragmentation is what she's not going to want to talk about. I guess that policy coming out in a number of days, if not weeks. But, John, it's radically different in the polarities there. And I know we look at the Italian-German difference in yield as sort of the litmus paper, if you will, of the system. And they've actually been sort of quiescent, but I don't buy it for a minute. I think there's massive country-by-country challenges there. And again, a region at war.
That the Italian-German spread that you bring up, Tom, that's coming from about 240 at the wides, all the way back in, sub 200, pushing around about 180. So a bit more behaved this time around.
On your sababbatical, you move the needle on GDP.
Is that what happened? I brought spreads in.
Yeah, you
Thanks for that, Tom.
Single-handedly.
When are you going to let this go? You've got to take a vacation sometimes, Tom. It's good for you. You take a breather. I know you like the European way secretly. I know you do. Which is why you love talking about Euro Swiss and all things European.
I'm going on a Halls when Romaine goes on Halls.
You're going to call it a Halls?
How do you call it?
A holiday.
Halls.
A holiday. You can call it a Halls.
Yeah.
Or a vacation if you...
It's not cough medicine.
Don't you like holiday? Doesn't that make sense, Lisa? Doesn't that word
but
just...
Halls sounds like it's cough medicine.
Okay. All right, are we done? I think we're done. I think that's my decision. Asset price action looks like this. Romaine, I don't know how much we pay him to turn up this early in the morning to tune in for this.
You guys can keep going.
Romaine, do you get a bonus for tolerating this?
No, apparently not, but thanks for reminding me that I need to talk to Mr. Al here. Let's get a quick check here on the broader market, guys. We talked yesterday about all the weakness that we saw in the market. A lot of that drag came from those big cap tech stocks, and that's pretty much the story here in the pre-market. Not quite as severe as what we saw in the cash session, but definitely something to keep an eye on. Tesla shares down about 1% here on the day, setting up for a third day of declines here, of course, on this penultimate day of the first half. The first half that's seen Tesla shares now down about 33%. I want to bring your attention, though, to some of the macroeconomic conditions and the idea that you have a lot of stocks out there that some people think sort of are recession-proof. We got two interesting earnings, one out of McCormick, the spice maker, and one out of General Mills, and these stocks are going in opposite direction. General Mills surprising to the upside, those shares up 2.5%. Organic net sales growth coming in at 13%. Food service growth was up 25%, and their margins and everything else really just blew it out the water with regards to analysts' expectations. General Mills did talk about inflationary pressures, but said they were able to navigate that. Meanwhile, we heard from McCormick, which was talking about those same inflationary pressures, and apparently they weren't able to navigate that. They actually posted a surprise decline in sales, and more importantly, their gross margins contracted by almost 5 percentage points. Those shares down 7% here. on the day. Flip it up. I got a couple stocks here for you, Tom, as you prepare for your holiday season here. Keep an eye on Pinterest. I know you're a big Pinterest guy. Changing up the guard there. The CEO and also the founder of the company.
What do you think? What was he pushed out?
I don't know if he was pushed out, but he's been there for some time, and there's been a lot of concerns by investors that maybe he wasn't the person to continue leading this company. He is stepping aside. He's going to stay with the company, Tom. So don't worry, he'll be there as an executive chairman.
CK loves
but they're
Pinterest.
building and Bill ready. Yeah, Tom.
Romain, can you tell me what Pinterest does, because I still don't know?
It's an advertising-based platform, John.
What do you do on it, though?
You could plan out your wedding, Tom. You could plan out your holiday.
I mean,
Tom, when you're getting ready to go on your holiday, you want to find a nice shirt, pair of shorts, flip-flops.
I studied it for social media. I was asked at Bloomberg to study it.
Have we got a Tom Keene account on Pinterest?
Study it,
there may be some debris out there, but John, I never figured it out.
Yeah.
It's hugely female and it has a real geographic bias to the Midwest.
Keep going, Tom. I mean,
no, it's true.
We all want to know. What does that mean?
I don't know. It's like planning weddings, just like Romain said.
Well, Tom, I mean, you know, the event.
Lisa, weigh in here.
No, Lisa's just letting this go. She's just giving you. Ramo's just giving you more rope. Ramo's just giving you more rope. Carry on, TK.
Please. Want to keep going?
I think I'm done, guys. Coinbase down 2%, Tom. I know you care about that too.
Tom might be back in the next
Happy
segment.
holidays,
We'll
guys.
find out in about 5 minutes. Romain, thank you.
You're welcome.
Romain Bostic, we appreciate it.
I'm
And we
glad
look
that
forward to the close.
Yeah, I'm glad Romain mentions General Mills. I weighed into the General Mills piece there, the 9-year piece. Back then it was a 10-year piece at a 102. I'm enjoying it this morning at an 81.
Have
That's
you
called
studied that
price
too?
down, yield up. Got it right.
It's a greatly
Kathy
female.
Jones here, so I can yell at her because she told me to get
You
into
hope she's still
bonds there. She fixed income strategist at Charles Schwab. Kathy, that's the reality. Not a bunch of bond strategists talking about spreads and credit quality. People listening and watching bought a piece at par and they're enjoying it at 81 or 82, like the General Mills 2.25 of 31. What do you do if you own that bond?
Well, you have two choices, Tom. One is you hold it to maturity and it goes back to par, because that's what bonds do unless there's a default. Or you sell it now, take your tax loss, and replace it with a higher yielding bond.
Kathy, when does the concern start to creep in that we're not seeing issuance really pick up and that a lot of companies can choose not to now, but maybe in 6 months and certainly in 12 months, it'll be less of an option?
Yeah, I think right now corporate balance sheets are still among the investment grade community still pretty strong, and they did load up on debt at lower yields, so they're in pretty good shape. But we'll probably see issuance pick up. There's always going to be a window open, later on in the year as we get into next year. There will have to be some refinancing that takes place. I think a lot of the issuance now is just waiting for yields to come back down.
Do you think that they will? I mean, that's the issue. If they don't come back down, they're looking at financing costs that are double what they were potentially just a couple of years ago. How much does the need for it to come down really determine the next default cycle?
Well, I think when you're talking about high yield or certainly bank loans, then you have a problem with short rates moving up, particularly in the bank loan sector, because they adjust. The duration's very short. They adjust very rapidly. And for those companies, which are basically junk companies, their cost of financing is going to jump, 40, 50%. And that is one reason we're not big fans of bank loans right now. I think it'll also hit the low end of the high yield market because, spreads have moved up a bit here, but they're probably going to move up some more. We think there's a high risk of recession, particularly if the Fed goes really hard and fast the way they're talking about, and that's not going to be good for the high yield market.
An historic moment for global Wall Street. We interrupt with Kathy Jones of Charles Schwab. Euro Swissy plunges through parity right now. Strong Swiss franc, and that is an unexpected off what SNB did a number of days ago. Kathy, that speaks volumes of the unexpected out there. What is the unexpected if the Fed moves 75 beeps in July or onward?
Well, I think it does translate into the FX market. Obviously, if the Fed goes 75, that's built into the market, and I think a fair amount of tightening is built into the market. If Loretta Mester gets her 4% next year, then I think that we're seeing an inverted yield curve, all else being equal. It'd be very difficult with the economic indicators rolling over to see yields move up from there. I think you've seen an inverted curve. And that translates when we look at, say, the Japanese bond market and where the yen is and what's happening in Europe, that's going to translate into a pretty stiff global tightening cycle. And that's when things break.
Kathy, thank you. You're one of the best. I love hearing from you. Kathy Jones there
There's
of
the
Charles Schwab.
phrase.
Thank you. Break, Tom.
That's when things break.
Yep. Here's the choice that the S&B faces according to Kit Jukes. Either, and the choice is simple, he says, they intervene in whatever size the markets demand or let the franc fly through Euro-Swiss parity and overshoot. Is that the beginning of that right now, Tom?
Well, it is, and of course they've been very creative with equity ownership. I mentioned the Apple shares, I believe 71 million earlier, John, but it's much more than Apple. They're basically running a sovereign wealth fund within the S&B. I guess that Mr. Jordan can correct me on that, but that's sure what it looks like. Each country, and at Francine's panel, John, each country has its own challenges, but I'm going to say this, and I'm not just saying this because you know how much I love John, but United Kingdom is exceptional here. It is where people have secondary ownership. It's where they travel to. The city is the global financial center, and Governor Bailey on this panel today is not only for the United Kingdom, but international as well.
As a case study, I agree with you, Tom, but do you think from the perspective of consequences and spillover, potential spillover?
No, it's always Powell.
That's Powell and the Lagarde,
it's
isn't it?
always Powell.
Still.
Yeah, still. I mean, you look at the unexpected. We're looking at Euro-Swissy. We're looking at Finland and Sweden and NATO. John, these are things I never fathomed in my life.
I just can't wait for your Pinterest coverage in the next segment. That'll be fun.
Well,
You're going to give us a price target.
I don't even know how to log on anymore. Let me see if I can log on the break.
Went on our website maybe once, Brammer. I've got no idea what I'm doing there. Zero. Was it mood boards or something?
I've got to be honest, even though I am female, I have never logged on either.
Gone on it. I'm sure people share that view.
Your kids are on Pinterest, Bramo.
I don't think so.
Doesn't he do Nike? Rare Nike sneakers.
Yeah,
on Pinterest.
He's more. Yeah.
Futures down a tenth on the S&P. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Turkey's President Recep Tayyip Erdogan will meet with President Biden to push for the purchase of new F-16 warplanes. The two will talk during the NATO summit in Madrid. Erdogan is now seeking to capitalize on a relatively positive atmosphere in relations with NATO and the US. Ties had grown cold after Turkey brought advanced Russian air defense systems. The pressure is building more on European Central Bank to raise interest rates for the first time in more than a decade. Inflation in Spain has unexpectedly soared to a record 10% that beat all estimates in a Bloomberg survey, and it dashed hopes that inflation in Spain had peaked. The wife of Supreme Court Justice Clarence Thomas has declined the January 6th committee's request for her to testify. A lawyer for Virginia, Thomas says there is no sufficient basis for her to appear before the panel. Emails have indicated that her efforts to prevent Joe Biden from taking office were more extensive than previously known. And Disney has given a vote of confidence to embattled CEO Bob Chapek. It's extended Chapek's contract for 3 years. He's battled controversy and a crippling pandemic. At the same time, though, Chapek has spearheaded Disney's transformation into a streaming powerhouse. The entertainment giant is coming closer to overtaking the existing #1 service, Netflix. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The 120, 130 levels, you're beginning to really start getting that pain threshold. And we got that before it started coming off again. So I think that's the target you're looking at. 125, 130 is really when you start seeing demand destruction kicking in.
Kona Hag there, the head of research at EDF Man. Fantastic to catch up with her, always is. Futures just about negative, bouncing off the lows. We're down by 0.06% on the S&P. On the Nasdaq 100, down by 0.15. Things improve. Yields lower by a basis point, 315.84 on a 10-year. Bill Ackman, the hedge fund investor, out on Twitter this morning, Tom, says the following. Business is a confidence game. CEOs are losing confidence because of uncertainty due to the perceived risk of sustained high inflation. He goes on to say the Fed must act decisively to subdue inflation and inflationary expectations. Then business confidence will be restored. That's the view from Bill Ackman this morning, something he said a few times over the last few weeks.
It's in the textbooks and very Greenspanian, and what I would suggest to it is this new word, John, and maybe you'll hear it in this panel. I don't think so. It's sort of a Bullard-esque word, is front-loading. We've been talking about this on surveillance for months.
TK, I think that's something that will come up because that's some of the theory.
Just get it done.
That's some of the theory. I agree with you.
Get it done kind of thing. Here's what we're going to do. We've mentioned it, oil up 6% off the bottom really now. Brent crude 119. Excuse me, I missed that, John. 118 up to 119.23. Enough to get Will Kennedy on, Bloomberg executive editor for energies and commodities as well. Will, I want you to talk about something I learned in school, which is Blasian demand destruction. This is the demand destruction that Javier Blas writes about. Are you seeing demand destruction across Europe when Javier Blas tells me that Netherlands natural gas is over $200 equivalent dollars of Brent barrel? Is it evident out there yet, demand destruction?
Perhaps at the margin, Tom. I don't think there's been widespread demand destruction. We've seen some heavy industry close down. The UK, for example, has lost a fertilizer plant. It had two, now it only has one. That's been closed permanently. Fertilizer, of course, one of the most gas-intensive industries out there. We'll no doubt see more if prices stay at these levels, and they probably will. But the other thing I would tell you is that it's summer, and gas demand really isn't at its highest, and where we're going to see the impact is going into the winter, where people are going to have very tough choices about how much to heat their homes, and they're likely to be colder than they were last winter.
And Brent Crude, what is our reporting of the significance of going through whatever the daily moving average kind of high is? I'm looking here, Will Kennedy, right now, and I know it's like a 127, 128, but really the peaks have been, we're almost there, like a 124 as well. What will be the significance of a 125 print?
I think we're looking at a resurgent oil price here. One of the things that I would say about oil right now is that when you look at the time structure, the relative value of contracts across the curve, people are really pricing the front month, the front of the curve really, really strongly. And that's telling you there's a lot of desire for barrels right now that refiners are willing to pay up. And I think that, it can attack those levels that you discuss quite quickly, and of course once they go through them, that often gives a bit of a surge. So there is a bullish argument to make from these levels, Tom.
Yeah, and Lisa, Michael Tran with Halima Croft at RBC was blistering today about asymmetric calls of where you go to 150, and he even mentioned above 150. He alluded to that, Lisa.
Which raises the issue of demand destruction, which so many people have been looking for as the remedy for some of the high prices. Will, how much are we already seeing that? And I'm pointing to the Conference Board's survey that it put out yesterday, showing that people were ratcheting back plans for road trips and even for just general vacations over the next 6 months.
Yeah, that was a very interesting piece of data, Lisa. As you say, people have really changed their expectations of how much they're going to drive this summer. And if that comes true, then obviously demand will be lower than otherwise thought. But we're not seeing that necessarily in the market yet. The American refining industry is still working as hard as it can to produce gasoline and diesel, suggesting that customers are willing to buy whatever they can produce. And refining margins remain extremely strong. We've been a bit starved of data because we had this server blow up at the EIA last week, so we haven't had any data for almost 2 weeks. We'll get some this morning, and I think traders will be very interested to see what the latest demand figures are for petroleum products in the US and whether they see any softening of the normal seasonal pattern.
Well, as NATO members meet, they're talking about possibly capping the price of Russian oil as you try to parse through what exactly they're trying to do. Do we have a sense of what the consequences could be on the price of crude?
It's a very difficult question to answer, Lisa. And of course, as you say, the scheme itself is quite complicated, and it requires the use of the insurance market to basically insist on a price for Russian crude. I think that when you looked at what happened at the G7 yesterday, it was an instruction to examine this idea more, which is a way of really kicking it into the long grass. I think that many people out there think that it's going to be too complicated, and that Russia will find ways through insuring the cargoes itself, for example, of bypassing it. So it's hard to see this happening in the short term at least, and that makes it very hard to see what the impact would be on the crude price. It would depend how Russia responded. Would they go along with it and get what price they can, or would they say, well, we're not going to play and take more oil off the market? I think those things are very uncertain.
Super complex. Will, a clinic from you, as always. Thank you, sir. Will Kennedy out of London. Just looking at the shares of Bed Bath & Beyond getting hammered in the pre-market. There's an executive change. The numbers, Lisa, they're really not great.
Yeah, adjusted loss per share, $2.83 versus the expectation for a 5-cent year-over-year gain. Just overall, not only is it bad in terms of what they have seen, but what they expect to see. And how much does this come down to inventory and planning for an environment where people are buying very different items than they were 6 months ago? How do you plan for that in advance in the fast-moving pandemic backdrop?
When did they get put out of their misery? I mean, they're negative 16% per year for the last 10 years. They're making, John, well, forget about the losses they're making. Even at the EBITDA line, it's pennies per dollar.
Do you want my amateur customer feedback, Tom?
I don't know.
There is way too much in that store. Way too much.
I heard his Bed Bath & Beyond gripes.
Way too much.
I hear you.
I mean, seriously, you go in there and it's just overwhelming.
I mean, I'm looking
Floor to
like as a
ceiling
CFA
stuff.
exercise, you look at their income statement and you go, really?
Well, the sales are down 23% in the first quarter, Tom. Mark Tritton, didn't he come over from Target, Lisa? Wasn't he meant to sort some of this stuff out?
Well, Target's having its own problems, right? I mean, how much are you seeing the tale of different retailers that planned accordingly in terms of how much they stocked up for a very different period in terms of what people are buying, how much they're going to have to actually discount, how much they're dealing with higher employee turnover, all of these issues that each company really had to deal with, and some did it all right and some didn't.
Final word on Pinterest, Lisa, you want to squeeze that in?
I'm actually gonna bail Tom out here.
Are you
Because
ready?
yes, I am,
Okay,
because
go on.
we were making fun of him for saying, overwhelmingly female. But it actually is, and as of January 2022, 77% of Pinterest's audiences were female.
TK said he'd done a study.
So evidently
did you
he
read,
had.
Did you read
I
his
was
study?
asked, John,
I read this
years
study by
ago
one keen
to do
T.
Pinterest. I mean, I've deleted the account, but like to do Pinterest to study if there was an audience.
What
and
is
we
it?
determined there isn't.
Did you do a mood board?
There isn't
Did
an
you make
audience.
a mood board?
No, it was me and, Sarah and, it was years ago.
Okay. All right, futures are up 0.1% higher, Tom. We're an hour away from Chairman Powell on a panel in Sintra, Portugal.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Tightening financial conditions is part of the Fed's solution to the inflation problem, which means, of course, the market will go lower.
We're not yet seeing any elevated signs of credit risk that would suggest a problem.
We're going to see a pickup in macro volatility. We are seeing that. I think this is real and persistent.
There is a path to a soft landing. It's perhaps narrower than many of us would want it to be.
A high probability of a hard landing. I'm not convinced we're priced for that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Not your average Wednesday. No question about this. Yes, economic data tomorrow. But, John, economic data in 1 hour. Francine Lacroix speaks to the world's central bankers.
What a lineup, Tom. Chairman Powell, President Lagarde, Governor Bailey sitting down with Francine. And we've got a couple of questions, haven't we? How much damage will they inflict on this economy? How much will they tolerate higher inflation? For how long? Tom, you've talked about that move down from 8%. Perhaps down towards 5%, 4%, 3%. These are the kind of things we need to try and tease out going into 2023.
David Rosenberg with a blistering note out of Toronto this morning saying, let's go. This is the front-loading concept. You wonder if that's going to come up. Let's get it done. Let's raise rates to get the first tranche of inflation slowdown to happen.
Loretta Mester on board of the Cleveland Fed. Let's go 75 again. President Mary Daly of the San Francisco Fed on board. Let's go 75 basis points all over again. It's not just about the Fed now, Tom. It's about the ECB as well. They're set to make a move. They're teeing us up for 25. Will they have to go a little bit more? German CPI, inflation coming in at 8.2%. The median estimate was 8.8%. That data's just come out. We had a little bit of a lead into that from the regional CPI prints out of Germany earlier this morning, looking for that downside surprise. You'll get the headline number, Tom, this Friday.
And the idea of double-digit inflation in Spain, obviously very, very different. Lisa, it leads up to looking at the tea leaves, and the killer tea leaf right now is Brent crude exploding out. What was it, 115 out to a 119 level, up 1.1%.
A different story than it was last week when people believed that there was going to be some sort of economic downturn that would reduce demand significantly for oil. That lasted about 5 minutes as people went back to realizing the actual market was really tight. I do want to just pick up on something, Tom, you were talking about earlier, the Euro Swissy, on the heels of that inflation data that John was talking about. You see it move back just a little bit. How much does the ECB dovetail this nuanced picture of inflation, a nuanced picture of economic deterioration in Europe, with a call of being hawkish enough to support the euro? And how much is that going to be the main theme out of this potential panel, Tom?
Let's get to the data check. We've got an important guest here. Getting Kit Jukes to join us later in the hour from SocGen on that panel. John, I'm just going to look at a bit of a reversal here with green on the screen. It's a nudgy tape is how I'd scientifically call it, John.
Just a bit of a lift. We'll use your word, a nudge higher, Tom. Up a third of 1% on the S&P, on the Nasdaq, up a third of 1% also. Yields in a couple of basis points. That's been the story over the last couple of days. We had a little look at 325 rather, on a 10-year. Still not used to that 3 handle. We had a little look at 325 in the last 24 hours and then backed away. Largely, Tom, because the data just has not been great stateside over the last few weeks.
Yeah. And again, the disinflationary trend. John, what do you make of the German inflation number there?
Expected after we saw the regional print, Tom. There's a story about travel and train tickets in there that have pulled things lower just a little bit. Does it change the mood music or just the volume on the mood music? I think it changes the volume. Doesn't change the track. It's the same story for this ECB. They've got work to do.
John and Lisa are going to pick it up here with Erin Brown. She's multi-asset strategies portfolio manager at PIMCO. But Erin, I need to digress. We had Abby Joseph Cohen on with us 8, 9, 10 days ago, and I think of the work that Sally Krawchuk has done with us over the years. No one I know is as invested in girls as you are in finance with Girls Who Invest. You've really put some quality time into that. Tell us where the momentum is now with Girls Who Invest, getting more women into this business?
Sure. So we've spent a lot of time really focusing on those very early onset years and trying to build a pipeline for more women.
Well, like finance. 7 or 8 years old, or you going a little older?
We're starting a little bit older. We're starting with sophomores in college, really priming them for being prepared to enter the workforce as they start to move into their junior and senior years, and really look at the industry holistically to really attract women as investors into the business. So not just looking to hire women into finance, but really specifically as investors.
And Lisa, what this is about is enjoying losing money early on so you become adult about it and actually get to work on it.
Equal opportunity to lose money in a market that's increasingly unclear. Erin, when you talk to individuals, women and others, as they come into the market, how do you try to frame the moment at a time when uncertainty seems to be the catchphrase for everyone, and people are looking at potentially a new, and I'm doing this just for you, Tom, a new paradigm for inflation and growth?
Absolutely. And I think that's really what we're seeing right now, which is a transition point in the market. This isn't a market unlike we've ever seen before. And I think that these growing pains and this volatility really does create opportunity. You know, certainly we've seen real violence in the markets year to date, but we're now getting to levels, particularly outside of equities. But when you look at fixed income markets, that, you know, optically at least are the most attractive that they've been in a very, very long time. I mean, with 10-year bonds now yielding, you know, upwards of 3%, and even cash rates offering pretty chunky yields, it's the first time where you can actually feel like fixed income actually offers value in markets.
And Erin, I know that PIMCO has come out with this call that there's starting to be a lot of value, particularly even in duration. And I'm wondering how you frame this out in terms of near-term versus long-term bonds, where in the world you would go for duration, and how much you are fully invested. I mean, how much is your conviction in this fixed income call?
Sure. So I wouldn't rush into buying anything, you know, sort of blindly right now. I still think that we're going to have some pains over the next couple of weeks and months as inflation starts to stabilize. Really what we're looking for to get, you know, much more bullish in terms of buying fixed income is starting to see inflation stabilize and start to roll over. We're not there yet. We probably have through the summer a couple of more painful months. That said, I think that you can start looking at duration more attractively as you own against fixed across a, you know, a broader multi-asset perspective, just given the fact that at least from a correlation perspective, it's starting to be somewhat more negatively correlated to risk assets. Also, when you look at IG bonds, they're starting to look pretty attractive. I still think that high yield, just given some of the negative convexity in those owning those assets, still has probably more downside to go, particularly in the riskier credits. But particularly against IG bonds and some high quality duration bonds, you know, I would start to, you know, dip my toe in now.
So, Erin, just to get a sense of the timing and just the progression of how you see the opportunity arising, you would dip your toe in now, but remain in cash or remain in liquid fixed income, and then wait for what before you become more fully invested in fixed income?
I think owning a little bit of cash, a little bit of sort of shorter duration corporates, and a little bit of duration makes sense, you know, as sort of very highly liquid instruments. And then as you start to see inflation really crest, that's the time when you're going to want to start to buy fixed income, you know, more holistically within your portfolio. You know, the one thing that I would say is that we've been in a market where duration's been selling off largely as a result of inflation, but we're coming to a point where each incremental basis point higher in inflation is really tipping the scales of the U.S. economy closer and closer into a recession, albeit likely a soft, you know, sort of recession or a shallow recession, but it is getting closer and closer. And so at this point, we're really quickly moving from late cycle, you know, into recessionary conditions. And that's where you want to start to increase fixed income within your portfolio.
So when Tony Crescenzi and Jerome Schneider are going at it, there's got to be a tip point on inflation where you act, and PIMCO's been just incredibly accurate on this. Is that tip point off headline inflation or some custom core inflation index you have?
So we do have a custom core inflation index, but right now what is impacting the consumer are necessities, and that's shelter, that's food, and that's inflation. Ultimately, that's what the pocketbook...
You link those into your financial instruments.
Yeah, you have to, because that's ultimately
well, tell that to Jerome Powell, does he? I don't think so.
No, I mean, I think, and I think that's why you may have the Fed tighten into an earlier than expected recession, because ultimately that's what's hitting the pocketbooks in terms of consumers right now. And that's what, you've already started to see non-necessities roll over in terms of inflation. But what inflation keeps ticking higher on are those necessities. And that's ultimately what's going to, create a shallow consumer recession. We're already, I think, in an Amazon recession right now. We've already seen retail goods, durable goods spending start to roll over. And I think that that's, an early canary in the coal mine for what's to come, in the broader economy.
Erin, awesome to hear from you as always. Erin Brown there of PIMCO, already in what she called there, Tom, an Amazon recession. For retail, for consumers.
Well, that's what we heard from Goldman Sachs as well. I just look at girls who invest, and can you imagine Erin Brown got the girls who invest sophomores all into that Austrian piece, that 100-year Austrian piece, and they're down like 70% like I am.
That was your investment advice.
That was my investment advice.
Not Erin's
to girls
back then
who
at the
invest.
time. Lorena Mester of the Cleveland Fed has just come out with some really interesting remarks, and we've written up the story, so allow me to bring you a paragraph of that. Fed research shows that it's more costly for policymakers to be wrong about inflation expectations being well anchored when they're not, as opposed to erroneously assuming they are rising when they're actually well anchored. That tells you something about where they see the balance of risks here, Tom, and why the likes of Lorena Mester are looking to front load this effort.
I mentioned this yesterday off of Jean Bovin, and Philip Hildenbrand was brilliant on this. This is going to be a huge debate. John, this really alludes to Jackson Hole going back to 2005 and Olivier Blanchard and the confidence that we have in stability of inflation.
She is in Camp 75, Elisa, going into that July Fed meeting.
A lot of people with her, front loading. Expect that to be the word of the day.
Futures right now up 1/3% on the S&P, on the Nasdaq 100 up 1/4. In around about 48 minutes, you will hear from Chairman Powell, President Lagarde, Governor Bailey, sitting around a table with Francine Lacqua of Bloomberg. Cannot wait for that. Looking forward to it. Full coverage right here on Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. NATO leaders are preparing to overhaul and boost the alliance's defenses in the face of Russian aggression in Europe. They want to establish a new force model that would put about 300,000 troops on high alert. President Biden says the U.S. will set up a permanent headquarters in Poland for the 5th Army Corps. NATO leaders are meeting in Madrid. The UK has imposed sanctions on Russia's richest person. Vladimir Putin is president of Norilsk Nickel, one of the world's largest producers of nickel, palladium, and copper. According to the Bloomberg Billionaires Index, he's worth more than $37 billion. And the pressure is building more on European Central Bank to raise interest rates for the first time in more than a decade. Inflation over in Spain has unexpectedly soared to a record 10%. That beat all estimates in a Bloomberg survey, and it dashed hopes that inflation in Spain had peaked. A former White House aide portrayed a violent and out-of-control Donald Trump in his presidency's final weeks. Cassidy Hutchinson gave the most gripping testimony yet in a House committee's hearings on the Capitol riot. But doubt has been cast on a key element of her second-hand account. Hutchinson says she was told the president tried to grab the steering wheel of his limousine after the Secret Service refused to drive him to the Capitol on January the 6th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
This is a Volcker-esque type of Fed where they are clearly focused on getting inflation down, and they are not going to throw away 40 years of credibility. They're not going to throw that credibility away just because the markets are telling them.
Greg Peters of PGIM, he is not constructive on this equity market. Speaking on the Federal Reserve, we'll hear from the Fed Chair Jay Powell in about 40 minutes' time. Futures right now up 1/3 of 1% on the S&P, on the Nasdaq up 1/4 of 1% also. Downside surprise on German CPI relative to what we expected, let's say yesterday. Once we got the regional breakdown of Germany this morning, it was largely expected. Euro dollar down about 1/10, 105.11. Yields in 2 basis points or so on a 10-year, 314.72. And just in the break there, I was working through that note, that speech, those remarks from Fed President Lorena Mester over in Sintra, Portugal. It's really interesting stuff. This is a massive change at this Fed, and you can see them working through it in real time. Here's the quote, Tom. The current challenging situation in which a sequence of supply shocks have contributed to inflation being at 40-year highs calls into question the conventional view that monetary policy should always look through supply shocks. In some circumstances, such shocks could threaten the stability of inflation expectations and would require policy action. It's the world we've been in, Tom, in the last 18 months.
She is the mathematician of the Fed. She's prodigious ability here at the dynamics that we're seeing now. I would say John Williams joins her in that ability out of Columbia and Barnard and Princeton as well. But John, it speaks to the uncertainties as we go to this panel now in about 40 minutes. Kitchuk's to join us in a bit. John, do note Brent crude out near 120. We're on our way up.
WTI 113, Tom, just creeping higher again.
Greg Villiers with us on the elections, on what we learned in the, I guess no, it's not the first Tuesday of June. We're late in June. But anyways, we had an election with some real results. Greg, I want to go to what the Democrats need to do to not focus inside the Beltway and have a Democratic Party strategy across this nation. Kate Zerinke in the New York Times destroyed the Democrats this weekend, saying they've simply failed to go across the nation in organization.
Yeah, you would think they'd be doing a lot better, Tom, on so many issues. I think that there is a need for something more unified. Maybe the abortion issue will finally get the party together. It's given them a catalyst. But you and she and her piece are right. There's a lack of unity and strategy.
A single sentence in your note this morning on the governor of California. What does good Mr. Newsom need to do?
Well, I think he's running. He's starting to run some ads. I think he's making noise like he may run. You know, everybody's frozen in place right now because of Joe Biden. If Biden announces he's going to seek a second term, which I doubt, but if he does, that changes everything. If he doesn't, I think Newsom runs, and believe it or not, don't shoot the messenger here, I think Hillary Clinton may give thought to one last run.
Wait, what? Say that one more time, Greg?
Yes.
Sorry, I can't let that go.
Yeah, I mean, I do. There's been a lot of speculation in the last few days that if Biden doesn't run and the Democrats don't have any clear favorite, that she might hop into the race. She's 74. That makes her, you know, fairly young by today's standards. But I don't rule out one last run by her if Biden doesn't run.
Well, there's a lot to go on that particular line of questioning, Greg, but I do want to go back to the task at hand for all legislators right now, which is trying to deal with inflation, which is the primary concern for a lot of investors, the social issues creeping up in terms of priorities for some voters. But is there any chance that this Congress could really take action in a material way from a legislative stance in terms of financing different kinds of programs or offsetting some of the inflationary pressures, given the lack of unity and given the polarization that you were just talking about?
Logically, you would think the answer would be yes, they will. But logic does not dominate Washington. And I think that while there's a lot of talk about tariffs, a lot of talk about other programs that might help a little at the margin on inflation, I don't see it. Frankly, I think Ukraine is more important. And as long as this war continues, we're going to have high energy prices, high food prices. I think that's the bigger factor.
So, Greg, if that does spur some sort of recession, where is the fiscal impulse to respond?
Typically, doing the exact wrong thing at the exact wrong time, you're going to see Congress now get very frugal. Not a lot of spending. Republicans will take the House. They don't want to spend a lot of money. So just when you have monetary policy tightening, you're going to see fiscal policy tightening as well.
Greg, frame it for me. A Sunday evening, the end of March 1968, Lyndon Baines Johnson, overwhelmed by Vietnam, among others, said, "I'm not going to run again." I was sitting on the couch. I remember it clear as a bell, a nation stunned. What is Biden waiting for, or does he have to wait for March of 2024?
Well, the march that you refer to with LBJ occurs on November 8th. Here in the U.S., that's the election. And if the House flips, which I still think is likely, Senate is a tougher call now because of abortion, but you know that could slip as well. I think that would be the catalyst to push Biden out.
Okay.
It's not just his age; it's his polling numbers and the elections on November 8th.
Greg, we've got to talk about the other ticket just briefly. That testimony yesterday. I want your view on this. Does that change the support that the former president gets, and does that open the door a little bit wider for the governor from Florida?
John, June of the year 2022 will be remembered as the month that pretty much finished off Donald Trump. It's not just that he may get indicted. It's not just that he has lost some altitude in the party. It's the mere fact that more and more of his own supporters are telling poll takers that one term's enough. We really are not excited about him running again. And that's his own supporters who are now starting to say that.
That's the one to watch for sure. Greg, thank you. Greg Vanier of AGF Investments. Music to the ears, I imagine, Tom, of a certain Governor Ron DeSantis down in Florida.
I read his biography the other day. I think the guy, it's somebody that we're learning. I mean, down south, obviously, he's really known, and he's known well within Republican circles, but he has an extraordinary biography. I was really quite taken by the history, the path that he's taken, and then with all the notoriety in Florida, the polarization in Florida, I should say, John. It's somebody that, like, I've got to get to know, is how I'd put it.
I agree. I think a lot of people have got to get to know him, Tom.
Yeah.
And that testimony yesterday, we're going to be talking about that for a long, long time. We'll be talking about a certain panel coming up in about 35 minutes' time. A whole lot more on Bloomberg TV and on Bloomberg Radio. Chairman Powell, President Lagarde, Governor Bailey, sitting down with Bloomberg's Francine Lacqua. Can't wait for this, Tom. I've said that repeatedly for the last 24 hours. It's 35 minutes away.
Now, let's not forget Augustine Carstens. What there is some intellectual firepower at this panel.
I feel bad for
all from
Carstens.
different walks of life.
Who, of course, Tom, we've sat down with frequently over the years, but ultimately it's about the other three on this occasion, isn't it?
Yeah, I go with that, but it's what they don't say.
Futures up a tenth to 1% on the S&P. Yields in a single basis point on a 10-year, 315.66. Tom, laser-eyed, focused on crude, 113, almost 50 on WTI. From New York, this is Bloomberg.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Futures are positive, about 0.2% on the S&P 500. We are 30 minutes away from hearing from Chairman Powell and President Lagarde alongside Governor Bailey. And I feel bad for Carson Augustins because he's there too, and I haven't promoted him once all morning.
And nobody else really knows he's there.
Filling in the gaps there. It's one of those awkward things where you feel like you have to ask the other person a few questions, but ultimately you know everyone wants to hear from just two of them.
Absolutely.
Powell and
That's the way you are with me every day, John.
I think that's the way a lot of the audience are about this show, Tom. They just want to hear from Lisa.
Oh, stop.
The amount of hate mail that TK and I get about that. But anyway, that's another story.
She gets all the love notes.
All the time. All the time.
It's not fair.
Yields in 2 basis points on a 10-year. 314.90, Tom, on 10.
It's fascinating. I mean, Euro Swissy through parity is some real history. Even John, 119.50 on Brent with a $6 spread to West Texas Intermediate. And you look at Netherlands natural gas, John, which I really don't understand, other than Javier Blas says it's wicked important moving out to almost Ukraine war highs.
I don't want to be too selective with the stories. I think it's important too.
Yeah,
for the
I
other
agree.
side of things too, because yesterday we talked about China coming back online off the back of cutting a quarantine period, not getting rid of it, but easing it for travelers. She came out and basically just said, herd immunity, no thank you. Let's stick to COVID zero. That was a pretty strong statement from Xi, according to Xinhua News. Our country has a large population. Such strategies as herd immunity and lying flat would lead to consequences that are unimaginable. That's President Xi. So if you're thinking about their stepping away from COVID zero anytime soon, well, the leader of the Communist Party in China clearly has other ideas.
John Burns Murdoch at FT making very clear, John, there's been a little bit of a tick up in the variants, whatever they call them, in the virus, and a little bit of a tick up in the statistics here. Not concerned, but nevertheless something to watch for. Here what we're going to do. We welcome all of you on Bloomberg Television and Bloomberg Radio. Jonathan Farrow, Lisa Breinwitz, and Tommy. John, are you going to stay with us till 9 today?
You've got me
I believe so.
Full hour this
special coverage here.
So special.
28 minutes away here from really the conversation of the year in central banking. Francine Lacroix with leading central bankers. We start strong this half hour with Jay Bryson, chief economist at Wells Fargo, with international finance work at the Federal Reserve, I should say, as well. Jay, I want to take the other side of the gloom that's out there, something David Rosenberg's talked about and the wonderful John Sylvia's talked about with his sense of history as well. There can be high inflation, and then suddenly there's not. To go back to World War II and 20% inflation of 1947 and on down to the Eisenhower disinflation. Is there disinflation out there, Jay, that we just don't see right now?
Well, so disinflation, I think disinflation is coming next year as the economy slows because of the central bank rate hikes around the world. The question is, where do you settle out in terms of the inflation rate? Now, are we going back to 2%? I don't think so. So what if we settle out at 3% here in the United States? Is the Fed happy with that, or do they think they have to get us back to 2? That'll be the interesting, sort of question going forward.
Olivia Blanchard and Adam Posen, particularly Dr. Posen, have really advanced this idea of 3% as a new level. You remember what Olivier did at the IMF right off the crisis there of modeling even 4%, and he was taken out to the economic cleaners for even mentioning 4% is a viable goal. What do we do, Dr. Bryson, when we get back to 4% inflation?
Well, Tom, I think maybe what we're going to be looking at going forward is what the Fed did in the 90s and the first part of the century here. And that was, they called it opportunistic disinflation. So if you go back to the 90s, right, the inflation rate throughout the 90s was like 3.5%. That sounds high relative to where we were in the last 20 years. But, the economy performed pretty well. And what the Fed decided to do during that period of time is not put the economy through a ringer. They called it opportunistic when recessions came along and the inflation rate came down, that reset expectations, and they went from there. And so I wouldn't be surprised if we settle out at 3.5%, the Fed says, okay, victory, we're done, and we're going to wait till the next recession to bring it back down to 2.5 or 2 or something like that.
Jay, that was the consensus last week, and it seems like we're getting an increasing amount of angst around that consensus, that ability for the Fed to step away once there is the right trajectory of inflation and wait and be patient. I want to go back to that Loretta Mester quote that John was talking about, Cleveland Fed president, where she was saying that essentially Fed research hints at a greater risk of not going hard enough with respect to rate hikes and allowing longer-term inflation expectations to become unmoored than the opposite. In other words, it's actually more of a risk to not be hawkish enough, and that is why she believes in perhaps a 75 basis point at next month's meeting. How much is this the new idea at the Fed, that they need to be more aggressive or fear a repeat of the 1970s?
Well, so, I think it's interesting to see what the consensus at the Fed will be. I mean, obviously, President Mester is a little bit on the more hawkish side of things. I think she would, be very close to where Bullard is right now as well. But there's other members of the FOMC who don't take such a hawkish sort of view. What is John Williams thinking right now? What is Chairman Powell thinking right now? And so, it'll be interesting to see how this whole thing plays out. And, again, I don't think we're talking the difference between, say, 12% and 2%. We're talking about, hopefully, the difference between 2 and, let's say, 4. Okay, and reasonable minds, I think, can differ in there. But, Lisa, back to your point, if inflation expectations, if suddenly we're looking at what people are thinking is inflation is going to be 7% over the next 5 to 10 years, that's a whole bit different story. And if you just look at the most recent University of Michigan long-term surveys, 5 to 10 year survey, that's still around 3%, maybe a little bit north. So I wouldn't say that inflation expectations have got completely unmoored at this point yet.
Jay, you've got a recession call for next year, haven't you?
Yeah, that's right. We think we're looking at a mild recession starting sometime mid-2023.
Can you talk to me about the character of that recession? You use that word mild. I hear that a lot. What brings you to that conclusion, Jay? What is it about where we are in this economy that means the downturn, if we do get one, isn't going to be severe?
So if you look at the underlying fundamentals of the economy right now, let's start with consumer balance sheets. Consumer balance sheets are actually in pretty good shape right now, across the board. The household sector is not levered up. As a matter of fact, the debt to income ratio of the household sector is back before lower than what it was before the housing bubble started to inflate. Business balance sheets in general are also pretty good right now. The banking system is very, very well capitalized. So, I don't think we're looking at a 2006 sort of scenario where the system was just completely levered up. The banking system was not very well capitalized. And so the economy should be able to withstand all these other sorts of stresses. That said, there may be things out there right now that none of us really know about. And the problem with recessions is the stresses from that. It tends to, if there's underlying cracks in the foundation, they tend to widen. We just don't know what those cracks are yet.
Jay, the counter argument to this is Rob Arnott of Research Affiliates coming out in an interview with Bloomberg saying the simple fact is recessions are usually created. They don't happen naturally. Economic expansions don't die of old age. They're murdered by the Fed. And we're seeing that happen again now, that the Fed is going to have to go so aggressively that it will kill the economic cycle, and there could be a lot of downside because of how much the Fed has done in terms of easing for the past decade. What's your counter argument to that?
So my counter argument to that would be, so if you're looking at, so did the Fed kill the expansion in the very, very early 1980s by the monitor experiment at the Fed? Yes, the real Fed funds rate at that point in time, it went up into high single digits. Interest rates were extremely high at that point. I don't think we're looking at the Fed raising rates into double-digit sort of territory here. And so what we're looking at is, a recession, right? But I would say it's benchmarked to the 1990-91 recession. Peak to trough decline back there was 1.5%. Peak to trough decline in the early 1980s was 2.5%. And then what we used to call the Great Recession, the financial crisis, that was like 4%. I don't think we're looking at those sorts of things. I think, again, it's more of a early 1990s sort of downturn that we're looking at.
Jay Bryson, thank you, Jay, of Wells Fargo. Looking forward not precisely looking forward, but looking ahead, I guess, to potentially a recession next year. Forgive my choice of words. Bed Bath & Beyond, the recession's here, isn't it? I think it was Aaron Brown about 30 minutes ago said the recession here is Amazon. The Amazon recession is here already. Bed Bath & Beyond is down 15%. Do you want a quarter-to-date guide from Bed Bath & Beyond? Comp sales in the down 20% range. Lisa, some of these numbers coming out of these retailers are just absolutely remarkable. And we've talked about this now for a number of weeks, whether it was Target, Walmart, Bed Bath & Beyond, really take your pick. Why are we surprised by any of this? And when we talk about the retailers and the difficulties they're having or will have, I get a ton of pushback about this, Lisa, quite often. People say, well, that's obvious, I know. Why aren't the earnings down already? Right. Why aren't we forecasting some of this? And then you see these moves in the stock market, and clearly it's not well priced at all.
I think it's very difficult to get your head around what the challenge is for retailers. It's not just supply chain disruptions anymore. It's not even inflationary pressures, which are well understood in some areas of the market. It has to do with changing appetites of just consumers, right? They're buying different things. And how much do you deal with inventories that you pre-ordered that suddenly are coming in that nobody wants?
John, I've never seen this before. At NATO with Maria Tadeo and Anne-Marie Horton, there is a meeting of the President of the United States and the leadership of non-NATO members, Japan and South Korea, Secretaries Blinken and Austin in attendance as well. John, this is just, all the rules are getting broken. This is on China. And while NATO is a group of the North Atlantic Treaty Organization, is going to adapt.
One to watch for the rest of today. Futures down 0.1%. You will be hearing from Chairman Powell, President Lagarde and Governor Bailey in around about 19 minutes' time. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Cleveland Fed President Loretta Mester says central bankers should act forcefully to curb rising price pressures. In remarks prepared for the ECB forum in Portugal, Mester said central banks should not be complacent about increases in long-term inflation expectations. Mester told CNBC earlier that the Fed is just at the beginning of raising interest rates. Turkey's President Recep Tayyip Erdogan will meet with President Biden to push for the purchase of new F-16 warplanes. The two will talk during the NATO summit over in Madrid. Erdogan is now seeking to capitalize on a relatively positive atmosphere in relations with NATO and the U.S. Ties had grown cold after Turkey bought advanced Russian air defense systems. And the wife of Supreme Court Justice Clarence Thomas has declined the January 6th committee's request for her to testify. A lawyer for Virginia Thomas says there is no sufficient basis for her to appear before the panel. Emails have indicated that her efforts to prevent Joe Biden from taking office were more extensive than previously known. Shares of Carnival slumped after Morgan Stanley warned the cruise line could lose all its value in the event of another demand shock. Carnival and peers like Royal Caribbean saw their revenue plummet during the pandemic. Shares were down roughly 50% for the year. The European Union is effectively heralding the end of an era of internal combustion engines. EU members have endorsed a push to eliminate carbon emissions from new cars by 2035. Environment ministers struck a deal after Italy, the home of Ferrari and Lamborghini supercars, gave up demands for a 5-year delay. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We're not at peak yields there. I think we're going to see, front end of the curve continuing to be under pressure to go up, and recession risks continue to build up. So I think that's the story for the next few months until we see a bigger pivot for central banks, which we think will come, but it's going to be after some pain has been done.
Jean Bavin there, the head of BlackRock Investment Institute. What's about to happen in 10, 11, 12 minutes' time, the panel of the year, all the ingredients for the most interesting panel of central bankers you will see in 2022 and maybe, Tom, through the next several years. Coming up very shortly, you'll hear from Chairman Powell, President Lagarde, and Governor Bailey sitting down with Bloomberg's Francine Lacqua. TK, this is a big conversation coming up.
Jackson Hole is going to have a tough act to follow here, John. You've highlighted it this week, a 3-day panel, I believe it was. Lagarde sizzling, Loretta Mester sizzling, and on we go to this panel.
They've got some work to do, Tom. Just how much? And how much pain will they inflict on this economy as they try and bring inflation back down?
The times we live in, and particularly with a war in Ukraine, is evidenced by President Biden meeting with the leadership of Japan and South Korea as we speak in Madrid at NATO. Kriti Gupta here with a chart this morning. Kriti, what do you have?
Yeah, Tom, ahead of that central bank panel, which John just mentioned, the key question is how much work do they have to do? How hawkish, for example, does the Federal Reserve have to go? Which brings me to my chart of the day, perhaps a gauge to figure out just how hawkish they can go. So look at that 2-year TIPS yield. Something that Chairman Powell brought up in the last press conference was simply looking at real rates. They're negative for most of the yield curve unless you look at the front end of the curve. And this is significant because as we ask, once again, how much more hawkish can you go? oh, check this out. This is a part of the market that is still in negative territory. And since 1990, the Fed has never ended a tightening cycle while real rates were in negative territory. So simply the fact that this is still so far low suggests that there is quite a bit of work to do.
Kriti Gupta, thank you so much as well. We are honored that Kit Jukes could join us now, Chief Foreign Exchange Strategist at Societe Generale, with truly decades of experience on central banking. Kit Jukes, simply, what will you listen for on this panel?
I'm expecting to hear a lot of resolute comments about making sure they get the job done. A lot of talk about inflation expectations needing to get under control, and that effectively that fighting inflation and winning this battle is the single most important thing facing central banks with everything else that's going on. So I'm expecting to come out of this more convinced rather than less convinced that they're going to end up over-tightening because they have no choice to do anything else other than that. That's what I'm waiting for.
Things are very fluid right now, including a resurrection of divine confidence from a 2005 paper of Olivier Blanchard. But the new kid on the block, maybe it's front-loading, but maybe more Kit Jukes, it's Christine Lagarde dealing with the polarities of Europe. You live this with your 5 or 6 residences in the Iberian Peninsula. Tell us how you treat the fragmentation that she does not want to speak about at this panel.
I think she's trying. I mean, they're trying to come up with a plan that they can sell credibly to fight fragmentation. It's clearly going to involve sterilizing some bond purchases. You have to play a confidence game to stop people wanting to sell bonds, to stop people wanting to get the additional yield on them. The challenge that they face, firstly, is that yields in Italian debt and so on rose because U.S. Treasury yields rose. So they're on the wrong side of the Atlantic to solve the fundamental issue. On their side, they've said they want to stop buying bonds and then raise rates, but I don't think you can stabilize the bond market without buying bonds. So you need to sterilize the purchase, come up with a bit of sleight of hand, the kind of magic that the European Central Bank's been trying for a long time, in the hope that that does the trick and restores confidence. I don't know how confident they are about how fast they can restore that confidence, but that's the line they're going to try to tread. We've seen this before.
Kit, I don't want to be overly disparaging about the individuals on that stage that will speak in about 9 minutes, but at the crossroads of a pretty difficult moment for the economy and economic history, what do you make of it that we're being led by a couple of the lawyers?
I don't think people running committees need to be the world's greatest economists. They just need to listen to some great economists. And equally, some great economists say some pretty foolish things because they get stuck, like we all do, in their kind of perceived vision of how the world works. I do just think that having seen so many events come together which gave us so much inflation so quickly, it's impossible not to conclude that you have to hit inflation with a big hammer to get it back down, because you can't afford probably a significant slowdown after some big rate hikes and then pick up the pieces. And in 10 years' time, we'd ask, as we do of Paul Volcker now, did he really need to go so hard?
That's exactly what Loretta Mester is addressing today. She thinks the bigger mistake is not going hard enough than going too hard, in a paper over in Sintra, Portugal. I'd like your view, Kit, on the differences between, say, Europe and the ECB effort, the UK and the Bank of England effort, and the US and the Federal Reserve effort. I think we've sort of teed this up as some big conference where the three of them face the same issue. How different is it, the UK versus Europe versus the US, as they try and tackle this problem?
Always chalk and cheese, but the biggest difference in Europe is that there's a war going on in Ukraine, and Europe is hostage to, or certainly dependent on, natural gas supplies from Russia. And so European natural gas consumers, which includes industry, are paying a far higher price already than is being seen in the United States. That's a particularly European piece that means that there's the biggest danger for Europe is a recession that comes from that reliance on Russian natural gas. The UK has already got much tighter fiscal policy, an economy that's losing momentum, more labour market shortages than the rest of Europe. And so I think the UK is done, really, in the sense that we'll go on seeing higher rates here, but the economy's losing momentum very quickly here. I think the thing what everyone has in common is that households are seeing their real income growth turn sharply negative all at the same time as everywhere in the Northern Hemisphere. We told the kids they could have a holiday in the sunshine. We booked planes, and we all want to consume services instead of goods at the same time. And by the end of the summer, we'll have a lot less money left than we had at the beginning. That's a universal across Europe, perhaps particularly in places that can't get to the beach by car, train, or some means other than an airport.
Kit, I feel like you're talking directly to me as I look at some of the vacation plans we have lined up. There is this issue when you talk about paying for all of this, the currency transmission, and it brings us back to your world, the very heart of which perhaps is the policy differentials and the different kinds of economic backdrops that John was talking about. What is going to be the main driver here in terms of the differentials? Is it going to be the rate hiking cycle and how quickly different central banks can catch up to one another? Or is it going to be the economic outlook and the disproportionate impact from, say, a 50 basis point rate hike at the ECB on long-term growth expectations versus a 75 basis point hike in the United States?
I think it's a combination. I mean, the BIS annual economic report that came out, was it yesterday or the day before, really highlighted how everything is being moved by interest rates at the moment. So it's this Fed hiking that's really set the stage for everything. In my world, the first thing about that is the UK was first to raise rates, the US followed, and the Europeans are coming up last. Normally, in that sense, we'd get what we got, which was the dollar's strong earlier, sterling is strong even before the dollar, and then the euro will go on strengthening for longer. That's where the situation in Ukraine messes up everything, because I don't know how you buy the euro with that elephant in the room with us. I do think that coming out on the other side of a slowdown, what kind of economic recovery we expect in different countries will become important. But it has to be something sustainable. But I mean, in a sense, that'll be a nice problem. At the moment, we're just trying to, engineer soft landings rather than face hard landings. As central banks tackle these multiple shocks all at the same time. I think going in, everybody gets dragged in the same way as in previous crises. It doesn't matter where the global recession started. If we get a hard landing, we're all going to feel it. So the bigger question right now is, don't we get a hard landing? And until we know, the dollar stays bid.
All right, so Kit, given that, just last question to you. Do you have a sense that the dollar is peaking, that there really has been some sort of peak, at least the near term, in terms of the range?
No, I think, look, the dollar is, it peaks earliest when we have a really soft landing and we start pivoting from investing in the dollar to places where they're going to be raising rates, where they're going to be normalizing, where yields are more attractive. I just don't think that that's something we can do safely this side of September at the absolute earliest. I think what we're going to get is a period of volatility where we have to answer one question before we answer the question about the dollar, which is, have 10-year notes even peaked in yield yet? And I think that if they have, they're going to be extremely bumpy because the Fed certainly hasn't peaked yet. And probably hasn't peaked for several more months. So I think the dollar's almost certainly got another high in it. But if it doesn't have one, it's going to be awfully messy.
Kitchux, please stay with us from Societe Generale. John Farrell, Lisa Bramwitz, and Tom Keene on radio and television. A special hour here of Bloomberg Surveillance this morning. John, in preparation for, without question, the panel of the year, and I like what Augusta Carstens in the BIS said off of the Jukes report from Geneva, and that is there is no respite for the global economy.
Keep saying it, they've got some work to do. Mike McKee's with us as well. Mike, looking forward to this. Kit Jukes alongside us. Walk me through what you're looking for from this panel that's set to begin in the next couple of minutes.
Well, the obvious question, John, flows from what Kit was saying. How far do they have to go and how fast? But I'm not sure anybody has a good answer. Speaking with Fed officials in recent weeks, they kind of focus on the idea that we don't know what's going to happen going forward. A lot of what's in inflation now comes from external shocks that we could still face. So while we know we need to raise rates a lot, why do it all at once? I mean, there is an argument to be made for ripping off the Band-Aid, but just in case you're wrong, you can just do these big rate hikes going forward. Now, some of them may make that point. I think the other point that will come out of this is that the inflation problem is different in each of these three central banks. For each of these three central banks, in the U.S., it's COVID and the war and energy prices, and also external stimulus from the fiscal side. The Brits have energy prices and Brexit, and much of what's going on in Europe is, of course, from the war in Ukraine and energy prices. So they each have to approach it a little bit differently.
TK, I think that's the big point here going into this, that we've set this up as they're all tackling the same problem, and to some degree they are. But there are some differences here, TK, from country to country, economy to economy.
Yeah, I'm going to, we can go all day on this, but Michael McKee, I'm going to go on this with Brent crude near 120, 119.88 now, up $1.90. We've had a real run on oil here. Obviously, for all of these panelists, through 120 on Brent crude is their worst outcome. But for Europe, it is the crucible of their problem right now. Javier Blas, wonderful on European natural gas. We don't, Jerome Powell doesn't have the hydrocarbon headache that Christine Lagarde has, does she?
Well, not in the same sense. The Fed still has an issue with the fact that gasoline prices are very high, and that's what Americans think of as inflation. I was talking to some people about the Michigan survey and the New York Fed survey yesterday, and how they show a little bit of movement upward in long-term inflation expectations, but Americans have no idea what the inflation rate is. They just know what the price of gasoline is. So the Fed has the problem of headlines causing problems with expectations. And the real issue for the ECB beyond that is going to be this fall when we get into natural gas. The United States has plenty of supply, but Europe doesn't.
Kitchukes, how will this be expressed through foreign exchange? We note Euro Swiss through parity today, strong Swiss franc. I think the one surprise, Kit, we can say, besides the rebuilding at Arsenal, has been the Swiss National Bank and what they've done over the last 10 days or so. How is this expressed through foreign exchange, the challenges of these bankers?
I think the foreign exchange market still errs towards safe havens or towards central bankers, where they're, in a sense, they're reliable. The Swiss National Bank surprised everybody by being hawkish. The Swiss have a low inflation rate and a super strong currency because they're consistently hawkish when they can be. They saw an opportunity to start moving back towards and above zero rates over time, and grabbed it with two arms and sacrificed the idea of keeping the currency down in the process. And maybe they'll come in and intervene aggressively to try to sort of limit the pain on that front. But that tells you, in a sense, that tells you that the euro is already a good bit lower than it would have been were it not for the geopolitics. So the euro is held back by, the fact that it's got a central bank that wants to fight inflation, but they also have to fight fragmentation, and they can't do anything about natural gas supplies in the short run. So that they're more hampered. The dollar, I think, is different in the sense that it is just the world's safe haven currency at this point in time. When you have a hawkish Fed, you get a strong dollar, until it stops being hawkish. So I think that's just more, there's less differentiation in that sense. And I think that's why the dollar is the go-to currencies at times like this. And it's why when Paul Volcker was hiking rates so aggressively back in the 1980s, the dollar went so much higher than it is now by any kind of comparison. And so the danger is if the Fed really does feel the need to go hard, go big, that we're going to get quite a lot more dollar strength before we're done.
Mike, as we wait here for this panel, how much can these central bankers get ahead of the story when the story is so uncertain? Mike?
That is an issue for them because, as I mentioned, Americans don't know what the inflation rate is, but they know what gasoline prices are. And the Fed can't do anything about gasoline prices. So it is hard for them to control the narrative, especially when you have a president saying inflation is the Fed's problem. So they are going to have to work on their communications, and it is difficult for them. I think the ECB, in that sense, has a little bit easier job because everybody can look to energy and the war as a problem. But as Kit noted, they also have the fragmentation problem. So their communications are going to be about why we have to stimulate some economies at the same time we are tightening on some economies. And that's a tough story to tell.
If you're just tuning in on TV and radio, we're just waiting for a Start of a panel between Chairman Powell, President Lagarde and Governor Bailey in Sintra, Portugal. TK, they've just played this opening video. We've got someone making some introductory remarks. Then Francine's going to take over. And once Francine takes over, we'll bring you that panel. The TK, I believe that one is about a couple of seconds away now.
You with always the rudest questions. John, what's your question to Governor Bailey?
Why did they get it so wrong? And I think that's for all three of them. And some of them, Tom, have done a better job than others at about explaining it. But they got it very, very wrong. Let's be clear about that. And I think you've got to start with some pretty hard questions up front.
I think the other idea, and this again looking forward, is how you come down with an assumed disinflation, and you may get an assumed disinflation, but as Jay Bryson and others said, I thought Aaron Brown was great on it. I mean, you get down to what, and then what? And are we really setting ourselves up for a new higher inflation rate?
A special thanks to Kit Jukes and Mike McKee. I believe we can now cross over to Francine and listen in to a must-watch panel.
For almost 15 years of policy experimentation in an age really defined by stubbornly low inflation. Now, this year that has changed. As Claire was saying, our policy panel needs a little introduction, but I'm going to do it anyway. Jerome Powell is the chair of the U.S. Federal Reserve. Andrew Bailey, governor of the Bank of England. Agustin Carstens governed the Bank of Mexico before becoming general manager of the Bank for International Settlements. And of course, our host, the president of the ECB, Christine Lagarde. Now, just a reminder, between them, these institutions hold nearly $20 trillion worth of assets on their balance sheet. And they've, of course, maintained ultra-low, even negative interest rates for the better part of a decade with little disruption. They now have the unenviable position of presiding over the great unwinding of policy that may have permanently changed the architecture of global markets. So thank you all for joining us. We're going to have, I'm sure, a robust discussion over the next 90 minutes. Mr. Carstens, let me start with you as a central bank of central banks. You know, central banks in general have faced really a succession of crises over the past years, but also some of the structural factors, such as the green transition, digitalization, and increased onshoring. So how different will the future of inflation be from now on? How different will it be from the last decade?
Well, I mean, a very important change that has taken place in the last, I would say, 2 decades, or even more. If, for example, we compare this period of inflation with the 70s, is that we have much stronger institutional monetary frameworks and institutional framework for central banks. And I think they're far better positioned to combat inflation. If we go back 70s, and 70s have become a natural reference, we were at the time where, for example, in the Bretton Woods was failing. You don't have more, I would say, instability in a system when you are, for example, revising your exchange rate regimes. And that is not happening today. I think that the period of disinflation there established very, very strong basis to create new and more nimble, more agile, better prepared central banks. And I think, for example, the design of the ECB, our host here today, in a way incorporated many of those learnings. So, I mean, when you are in charge of combating inflation, what you need to be able to anticipate is that sometimes you will be surprised, because there are many elements that affect inflation and that they are not directly under your control. And I think to a large extent, this is what we are seeing today. And I see a very, very strong ability of all central banks to analyze, to incorporate that information, and to react. For me, if you look very careful what is going on right now, in the last 2 years, we have seen dramatic changes in the environment. We went from having a situation where depression was felt, was feared, deflation was coming, to a very quick rebound with the vaccination and so on and so forth. And we moved tremendously quickly from an environment of fearing deflation to fearing inflation. And that has been compounded by the Russian crisis. I have to say, monetary policy, as nimble as it can be, cannot respond with that celerity. So I think that the knowledge of the new form of inflation is being learned and is being responded. So I'm very positive that this institutional framework and strength of central banks today will take us to the goal where we want to be relatively soon.
Chair Powell, do you agree? I mean, when you look at complexity and uncertainty, has it always been this way, but we forget about it? Or is this really a new frontier?
I agree with everything Augustine said about institutional progress. But I would add this. We've lived through a period of disinflationary forces around the world. This is globalization, aging demographics, low productivity, technology enabling all of that. So we've been in that world where inflation was really not a problem in most of the advanced economies most of the time. Since the pandemic, we've been living in a world where the economy is being driven by very different forces, and we know that. What we don't know is whether we'll be going back to something that looks more like, or a little bit like, what we had before. We suspect that it'll be kind of a blend, but in the meantime, we've had a series of supply shocks. We've had very high inflation now across the world, certainly through all the advanced economies, and we're, to Augustine's point, we're learning to deal with it. Our job is to find price stability and maximum employment, in the case of the Fed, in this new economy with these new forces. And it is a very different exercise than the one that we've had for the last 25 years. Nonetheless, the goals are the same.
So I don't know whether, Madame Lagarde, after this volatility, do we go back to something that resembles the last 10 years, or is it, something else completely?
I also agree with most of the points that Augustine made, and we don't have to agree between us because we always do. But I don't think that we're going to go back to that environment of low inflation. And I think that there are forces that have been unleashed as a result of the pandemic, as a result of this massive geopolitical shock that we are facing now, that are going to change the picture and the landscape within which we operate. If I look at our euro area, for instance, we have record low unemployment. We have inflation expectations, however imprecise and with the pinch of salt that was discussed at the last panel, which was excellent, we have inflation expectations that are much, much higher than they were. That's for the internal matters. But if you look at the rest of the world, a lot of the movements that we've experienced in the last 20 years was predicated on globalization, on the breaking down of supply chains, on the reduction of cost, on the just on time. That has changed and will probably change continuously towards a system that we are not certain about at this point in time, which is much debated. Some would argue that globalization will continue in a different format. Some would argue that the place where you manufacture, the place from which you provide services is going to be determined by different factors than just cost. It will be about cost as usual, but it's also going to be about where do I locate my services? Where do I employ people? Where do I reduce my costs? And are those areas, geographical as well as political, actually foes or friends? And do I have some predictability about the future of my production or the providing of my services? And the third factor that is going to change the scene, from my vantage point, is the way in which we produce. And I think that the shift that we're observing in Europe, certainly, towards green transition is also going to change dramatically the way in which we operate. And all those forces are going to produce inflation, deflationary impact that are still to be measured, but in the short run, I have some ideas as to where it's heading.
And we'll get back to those ideas shortly. Governor Bailey, do you see this as a sea change for the longer-term future?
Yeah, yes, I do. I mean, I think first of all we have to say that unquestionably, of course, our task is to return to low inflation. But I think, and we see this, every day, that in fulfilling that task, we're observing certainly, what can turn out to be structural change, and some of it, I think, I would say is already getting there. So I think COVID is leaving a structural legacy on labour markets and the way they behave, which we're already beginning to see. I mean, I think sadly the European security situation is changed. I mean, we hope it obviously doesn't persist, but it has changed, and that's affecting, as Christine was saying, that's affecting supply chains. It's affecting the resilience of the whole supply system. And you mentioned climate change, Francine. I mean, I would say that this is not, because some people sometimes say this is not some sort of dilettante activity by central banks. The reason that we're not in the lead on it, clearly, but the reason we have to take it seriously is because it is affecting our world. And actually, it will get worse. I mean, that's the sad fact of life. And we have to, in a sense, understand that and understand what effects it will have and how we respond to it. So these structural changes, are very important in our landscape.
So, Chair Powell, as these complexities or as these sands are shifting, is slower growth, much slower growth, an inevitable trade-off on trying to deal with inflation?
So I would say that if what we see, for example, is the redivision of the world into competing geopolitical and economic camps and a reversal of globalization, that certainly sounds like lower productivity and lower growth. And in many parts of this side of that, you see aging demographics, so a shrinking workforce, and you see economies that are growing more slowly and whose workforces are not expanding. So that's certainly a possible outcome, and I think probably to some extent a likely outcome.
And in the shorter term, can the economy, can the U.S. economy actually deal with a possible onslaught of interest rate hikes?
So the U.S. economy is actually in pretty strong shape. So if you look back a year, the U.S. economy grew more than 5.5%. It was really the big reopening year. Mm-hmm. And so we had expected this year to be that growth would moderate to a more sustainable path. We also, of course, are raising interest rates, and the aim of that is to slow growth down so that supply will have a chance to catch up. We hope that growth can still remain positive. But if you look at the strength of the economy, households are in very strong financial shape. They've still got a lot of excess savings from forced saving from not being able to travel and things like that, and also from fiscal transfers. So households are overall, not every household, and not the ones at the lower end of the income spectrum, but overall in strong shape. The same thing is true of businesses. Very, very low rates of default and things like that. Lots of cash on the balance sheet. The labor market is tremendously strong, still averaging very, very high job growth per month. So overall, the U.S. economy is well positioned to withstand tighter monetary policy, we think.
But is it automatically a trade-off between fighting inflation or taking care of the economy, and how far are you willing to go with interest rate hikes?
So I guess I'd say it this way. Our aim is to have growth moderate. It's sort of a necessary adjustment that needs to happen, so that, again, supply can catch up. It could be supply of workers. It could be time for the supply chains to improve. So the sense of that is that if we can get right now, supply and demand are really out of balance in many parts of the U.S. economy. The labor market being a big example of that. We need to get them better in balance so that inflation can come down. And that's the aim of what we're doing. Now, we don't have precision tools. Obviously, monetary policy, famously a blunt tool. That is our aim, that is our intention. We think that there are pathways for us to achieve that, to achieve the path back to 2% inflation while still sustaining a strong labor market. We believe we can do that. That is our aim. Mm-hmm. There's no guarantee that we can do that. It's obviously something that's going to be quite challenging, and I would also say that the events of the last few months have made it significantly more challenging, thinking there particularly of the war in Ukraine, which has added tremendously to inflationary pressures around food and energy commodities and agricultural chemicals and industrial chemicals and things like that. So it's gotten harder. The pathways have gotten narrower. Nonetheless, that is our aim, and we believe that there are pathways to achieve that.
President Lagarde, can you talk to us about this fine balancing act for Europe and what that means?
What I find extraordinary is that sort of 10, 15 minutes into this debate, we haven't really used the word energy. And certainly in this part of the world, the energy shock that we have suffered, are suffering, and probably will continue to suffer, has had a major impact. And I think this is not specific to Europe, but there is certainly a dependency of European countries, and the euro area is certainly a point in case, to external supply from foes. And that has had a major impact on prices. It is certainly a very driving force, a strong driving force of the inflation that we have experienced in the last few months. This has been, as you said, Jay, exacerbated by the war. And I think the proximity of Europe relative to the war scene has had a probably a more significant impact on the price both of energy and of food, which are clearly very important components to take into account, including in inflation expectations, as was discussed earlier. But we also have, that then is a series of supply shocks that are hitting the European economy. But we also have this recovery that is very much underway, that is certainly driven by services because of the swing that we've observed from goods to services, and which is also, supporting the economy. We have very low unemployment numbers, high employment participation. Some of it is more attributable to public service jobs than private sector, although that is also back to pre-pandemic moments. And we have a couple of other items, such as significant savings that are still to be used, hopefully, or not. And we have fiscal policy. And the fiscal policy that we are seeing at the moment is roughly in the range of 1% GDP. But, we need to see how fiscal authorities move, where they move. And we certainly hope that they will move in a targeted, temporary way in order to make sure that they support the most vulnerable and not in a broad and discriminated fashion as we have unfortunately observed so far.
Why do you prefer actually the more gradual approach? So yesterday you reiterated 25 basis points
gradual
hike.
For monetary policy?
For monetary policy.
Well, don't forget, I didn't say gradual full stop. I said gradual but optional. Yeah. And I think it's a combination of the two that actually matters for us. Moving gradually is certainly appropriate in times of very high uncertainty, but as the uncertainty will clear on various accounts, we will have to certainly be less gradual and give more weight to optionality. But we have both of them in combination at the moment, optionalities being also a very critical aspect of our determination.
Mr. Carson, you've been pretty vocal, actually, on what central banks should do. Do you think they need to cut faster?
Well, I think everyone should react according to their own circumstances. What is very satisfactory at this stage is that pretty much all central banks have starting address the issues. One way of dealing with it is through words, to recognizing you have a problem, to saying that you will address it, and pretty much all have already entered into the field of action. So central banks have been acting in consequence. I have to say the level of interest rates worldwide have adjusted. The level of interest rates, if you look them from the yield curves, they have been increasing quite substantially. What we can say is that global financial conditions have tightened substantially, because we don't have to. We shouldn't forget that this, in a way, has become a global phenomenon. Inflation around the world has been increasing. Now, each country, as Christine and Andrew and Jay has been saying, each one face different dynamics of inflation. In a way, I think what is very, very important is that in the realm of their own economies, what they should try to do is at some point prevent a full transition from a low inflation environment to a high inflation environment where this high inflation gets entrenched. And for that, basically, you need to prevent these vicious cycles to kick in. And pretty much all of them are addressing it. In these vicious cycles, labor markets are very important, and labor markets are very different across the world. Therefore, I think that there is no one recipe or no one remedy for all. But what I'm seeing is that pretty much all central banks have been addressing the issue in a forceful, determined way according to their own circumstances.
Mr. Carson, does it mean that you would be in favor of, front-loading hikes so that it's a powerful message, maybe to people, for a lot of the citizens?
Well, let me give you a good example, and to introduce a little bit of a different flavor here. I come from emerging markets, and if you see how emerging markets have been acting this time around compared to other periods of very high interest rate increases in advanced economies or the expectations of fast increases in interest rates, they have acted quite well, you know. I mean, if you see, the more recent episode was the temper tantrum, where many emerging markets suffered dramatically with the expectation of higher interest rates. My own country, Mexico, several of our crises have been associated with rapid increases in U.S. interest rates, but we have learned our lesson. And so what you see is emerging markets traditionally were the ones who would increase interest rates at the very end. Now they started very early on. And what you can see is that they have managed to keep their exchange rates quite stable. Traditionally, in emerging markets, exchange rates was a very important source of inflation. So now they're still facing the sources of inflation from the commodity shocks, from energy, from world aggregate demand, but not the ones that could have been inflicted by the movement in the exchange rate. So there you see that different central banks can act at a different pace. For them, it really was critical to act forcefully and very early on in the game. But that's not the circumstances you see around. So I mean, I would say that each central bank is playing its own game because it's different circumstances.
Governor Bailey, does the guidance from the BOE on moving forcefully actually open the door for 50 basis points?
Well, I think the way I would frame that, it very much goes back to what the others have been saying. And as Christine was saying, I mean, we are being hit by a very large national real income shock, which is coming from outside. There is uncertainty around two parts of that in terms of monetary policy. One is, of course, the eventual scale of it, because it's unfortunately still evolving. Secondly, the impact of it, precisely how it passes through into the economy and what the effects of it are. But the scale of the shock is very substantial, and in and of itself, it will have an effect, a big effect, because it will reduce domestic demand, and it will pass through into the labour market, and it will pass through into inflation. Monetary policy has, of course, a very important role to play because it will act alongside that shock. And it's very important, as we said, and this is where we come to the language that we use, that it, of course, is there also to tackle the second-round effects as they come through price setting and wage setting. So the message that we gave and was in the language of our last meeting, as you rightly said, was that if we see greater persistence of inflation, that's second-round effects, then we will act more forcefully. And we will have to act more forcefully. Now, in terms of your precise question, what does that mean? Well, of course, I'm not going to say what it means at our next meeting, because our next meeting is still a month away. A lot will happen between then. What I would say to you is that, of course, it leaves options on the table, and that's very deliberate. Very deliberate. I mean, I want people to take a message away from that. It's quite clear that as we respond to this shock, we want to have those options on the table for precisely the reason that Agustin has just said. There will be circumstances in which we will have to do more. We're not there yet in terms of the next meeting. We're still a month away, but that's on the table. But you shouldn't assume it's the only thing on the table. That's the key point.
But, Governor, for you personally, would you be leaning towards 50 basis points?
No, because I'm going to see what happens in the next month. No. I'm afraid one thing that is omnipresent in our system is that we make policy meeting by meeting, and there's always another meeting. If you can only guarantee one thing in monetary policy, it is that there's another meeting.
Yeah. Is it actually annoying that markets or reporters always try and understand, some of this very personal thinking on interpretation, for example? Chair Jay Powell, I mean, I tried my luck with Governor Bailey, but how do we, how should we be thinking about this? Like, is it, markets or reporters trying to really always get just that nugget piece of news?
Yeah, well, certainly there's a lot of that going on, I would say. But no, I guess I would, to put a more constructive spin on it, the markets and market participants are always wondering what we're going to do. They're always wondering what we're thinking. And when market moves happen, that's really a constructive thing. It's never going to be exactly what we're thinking, but nonetheless, it's constructive that the market, in effect, is doing your work for you if it correctly understands your reaction function. So that's maybe a more constructive way to
and is it correctly understanding what you're saying right now?
So I would say, by and large, I think over since last fall when we pivoted to to raise rates and get where we are now. Since then, markets have been pretty well aligned. I wouldn't bless any particular day, for example, but pretty well aligned with where we're going. And right now, you know, the market pricing is pretty close to where the summary of economic projections from, what was it, 2 weeks ago was. So my colleagues and I wrote down numbers for the end of this year for our policy rate between 3 and 3.5%. And markets are broadly right in that space somewhere. And then for next year, between 3.5 and 4%. So broadly speaking, I think it's working. And, you know, everything we say in terms of forward guidance, to your point, is always going to be conditional on the things that happen between now, when you give the guidance, and when the actual event happens. And sometimes markets can forget about the conditionality part.
But is there a problem actually with forward guidance in this kind of environment because it gets priced in straight away? So it feels sometimes like, you know, markets lead and central banks follow because of the forward guidance.
It doesn't really feel that way at all from where I'm sitting. It feels quite the opposite. And no, as I said, I think people will look back on this period and say that we were able to have financial conditions tighten quite substantially, and we've only had 3 meetings at which we raised rates. Nonetheless, the forward rate curve is pricing in, you know, a rate path that looks a whole lot like the summary of economic projections that my colleagues and I submitted in June. So that's a good thing. That's the market understanding and finding credible what we're writing down. Now, of course, it's all highly conditional, but nonetheless, I'd say that's a positive thing.
Yeah. Do you agree, Madame Lagarde? Is it a positive?
Yeah, I would agree. You know, from our vantage point, we are on a normalization path. We have signaled that very clearly. We've started that back in December. And, you know, the key assessment is the assessment of the medium-term outlook. The variables that we look at, the data that we look at, I think, you know, everyone is aware of that. And most people operate on the basis of the same data, the same information. And I think that our reaction function is what matters. And as long as that is understood, the fact that we are on this normalization path, that we are gradual but optional, that we're going to be data dependent. We've indicated very clearly what's likely to happen in July. Well, yes. What's likely to happen in September? Yes. And, you know, in the path that we are on, I think that markets have full understanding and appreciation of what we are doing, how we're doing it, and then the level of uncertainty as it clears will probably help us towards this optionality that I was describing earlier on.
Governor Bale, do you agree actually with the market function so far? Have they broadly understood what, you know, the central bank's trying to do?
Yes, I think they have. I think the tricky thing that you see, certainly I would say we see, is that, you know, we can obviously see direct market pricing. We can have an implied market curve which prices in what we're going to do. We also, as you probably know, and we just started doing this recently, publish a market survey at the same time as the meetings, and that actually shows a lower path of rates. So we spend quite a bit of time understanding the difference between those two. I don't think it's actually hard to explain, because I think the underlying reason is that the market curve prices in the risk, and the risk is on the upside, and I would agree with that. So whereas the survey is a straightforward, you know, point number, the curve has got the risk in it. So I think, you know, for me, the best way to look at that difference is the risk. But that is a risk in that sense. It's important to see that, you know, that perspective.
Yes, absolutely.
Not to get ahead of ourselves or to have to become big-headed about it, but there's a point that was made in a previous panel, which we all agreed over lunch, which is that it's not a science what we're doing. There's an element of art, I don't know whether you characterize it as art or not, but it is not just driven by sciences, and we know that models have had their shortfalls, particularly turning points. So there is also that element that is sort of privy to the deliberations that we have in our various governing councils and FOMCs and what have you.
Yeah. Yes.
Can I just add, we're talking a lot about markets and how we react to markets. Actually, to Christine's point, the way we're thinking about it is what policy setting do we need to put down to achieve the real economy goals that we're working on. And that's what we're not thinking, wow, let's try to match up with the markets. We're thinking, what's the right policy based on our, the incoming data and the evolving outlook and all those things that will get us to 2% inflation while ideally keeping the labor market strong. So it's really, we're talking so much about markets, I wouldn't want people to think that that's actually what we're aiming for.
We still have an hour on the panel, so we have time. Is there a piece of the? I mean, do you worry about yield curve inversion though? Is there a piece of that makes you worry, or do you just
So I would say this: we monitor a broad range of financial conditions. Honestly, the shape of the yield curve is not a top line worry for right now. Our focus is very intensely on setting policy in order to get inflation down to 2%. That's what we're working on. We understand that that's our primary focus right now. The labor market, of course, is extremely tight in the United States. So our focus is getting inflation under control. It's very important that people understand how committed we are to doing that. And that again, that's what we're thinking about.
Yeah, and I want to go back to the real economy and inflation in a second. But Mr. Carstens, what do you make of some of the what we've seen in market volatility? Is it just a readjustment? Is it a misunderstanding? Is there something that could turn uglier?
Well, markets are responding also to the circumstances. I think as policymakers, to some extent, have been surprised because there has been news that really are news and that were very difficult to anticipate. Markets are doing the same. And we have to, and you know this very well, markets are turning around very big positions. They're adjusting their portfolios. We are talking about a circumstance where for very, very long period of time, we had tailwinds in the bond markets. That we had very low and falling real rates of interest, falling nominal interest rates. So trading bonds was relatively simple. We had very big expectations for earnings into the future, a lot of interest in different sectors of the economy. Therefore, it was easy sailing for quite some time. But, the world has changed. The world that investors are facing and the world that we are facing. And central banks need to do their work, not as an objective in itself, but as all these central bankers have been saying, to fix a problem, which is inflation, and then continue with a much better world moving forward. So there are certain circumstances in markets where frictions are bigger. Trading conditions are not always the same. I mean, you get circumstances of crowded trades because at some point the same type of investors are trying to do the same operation and liquidity is not necessarily there. Something that for me has been very positive is that central banks, the leading central banks, have been able to implement their money policy adjustments without really generating such big, any sort of market disruptions. Markets have been performing well, liquidity is there, market making is going forward. Yes, there has been some disruptions. I'm not talking about the cyber world, that's another fish, or how do you say it, another kettle of fish. But I think that the markets have been working really well. And yes, behind the actions of central bank, there is always the concern that markets should be working adequately, because you don't want to have financial instability. At the same time, you need markets working well for the transmission of monetary policy. And so far, I would say so good.
Yeah. But at what point, and I think that maybe the last point on markets is how much do central banks need to deal with markets, Mr. Carstens, to see, to I guess, impact the real economy?
That's for you.
Yeah.
How much do we deal with them? Oh, sorry.
Yeah, I mean, how much do you need to focus on markets to make sure that also the real economy is quite strong?
Well, I mean, we spend a lot of time analysing markets, and all of that is fed into what impact those changes have on the inflation outlook. I mean, that's why we do it. With the second objective, as Agustin rightly says, of course, about market stability. because after all, we've also got financial stability obligations and responsibilities. I mean, I think if I go back to the panel this morning very briefly, I think the point was rightly made that it's turning points that are the hardest often to read, and it's not just for us, it's for markets as well. And I think certainly when I look at the UK economy at the moment, you know, it's very clear that the economy is now starting to slow. We are at something of a turning point in that respect, and I think the fact that, you know, markets are having to take that on board, and that, you know, the data can be quite choppy at that sort of point in time is reflected in some of the short-run movements in markets. Now, I do think one of the essential things for central banks is to look through that short run. Yeah. You know, we have to extract the information and then look through it, because obviously our objectives are much further forward in that sense, in terms of low inflation and returning to target. But in terms of, of taking the information out of markets, yeah, it's a very important activity for us.
Chair Powell, Paul Krugman, I think on Friday, said that the number one risk to the U.S. economy is that the Fed could overdo it because inflation could come down as quickly as it went up. Is that really possible?
Well, we'd certainly welcome inflation coming down more quickly than expected, and we would take that into account in our policy. So as I mentioned earlier, we're very strongly committed to using our tools to get inflation to come down. The way to do that is to slow down growth, ideally keep it positive, and as I mentioned, supply and demand get back into balance. So that's what we're trying to accomplish. Is there a risk that we would go too far? Certainly there's a risk. But I wouldn't agree that it's the biggest risk to the economy. I think that, the bigger mistake to make, let's put it that way, would be to fail to restore price stability. And it's to what Augustine was speaking to earlier, a low inflation environment or regime is what we've had. And that is one in which inflation is low and no one pays any attention to inflation, and that's called rational inattention, because it doesn't matter. When there's a big inflation spike, if it's going to go away, we would ignore it and sort of play through it, because it'll go away and it won't affect people's understanding. But to the extent there are a series of shocks, it does become rational for people to pay more and more attention. And I think the clock is kind of running on, how long will you remain in a low inflation regime where most of the changes in inflation are actually idiosyncratic as opposed to broadly across the macroeconomy. So the risk is that because of a multiplicity of shocks, you start to transition into a higher inflation regime. And our job is literally to prevent that from happening. And we will prevent that from happening. We will not allow a transition from a low inflation environment into a high inflation environment.
Is there a point where actually inflation expectations get de-anchored? And is that...
That's another way of saying it or thinking about it. It's the same thing, same idea. And the thing is, you never really know. There's no way to know in real time. We all study inflation expectations very carefully. And if you look across the broad scope of short, medium, and long-term expectation, you'd still say that we have credibility, that they're well anchored. But there's a clock running here where we have high inflation running now for more than a year. And no one should assume, it would be bad risk management to just assume that those longer term inflation expectations will remain anchored indefinitely in the face of persistent high inflation. So we're not doing that. As a risk management matter, we're working very hard on the part that we can affect, which is the demand side. We can't affect the supply side, really, but we can affect the large parts of the U.S. economy where there's surplus demand, and that's really our focus.
Is there a data point that you watch for to actually see whether there is a de-anchoring, or where do you see it first, basically, if it spirals?
The point is not to see it at all. We can't. Once we start seeing that, the cost of dealing with higher inflation goes up so much to the extent you find yourself in a higher inflation regime that you just can't allow it to happen. So if you're starting to see serious de-anchoring and we're not, of longer term inflation expectations, then you're behind. And I think right now we're doing what we need to do, which is to move expeditiously and into restrictive territory fairly quickly. I think that's what we need to be doing so that we don't find ourselves in that situation.
President Lagarde, what's the situation like in Europe? We had a pretty ugly CPI number from Spain this morning.
Yeah, numbers from Germany that are below what economists expected. So I think it's a question of waiting until the 1st of July when we have the consolidated number for the whole of the euro area, and we'll see, because we are data dependent. But just like Jay, our mission, our mandate, our job is to provide price stability. which we have defined as 2%. So we currently have inflation at, forecast 6.8 for this year, moving down to 3.5 and 2.1 in 24. All of that is above target throughout the whole projection period, and we need to do what we have to do, which is to bring it back to 2%, and we shall do so. Now, of course, we are not exactly in the same situation as Augustin was saying. We need to look at our markets, we need to look at forces, we need to look at how the uncertainty that we have on the horizon is going to clear. And I think that in that respect, what happens on the energy front, what happens on the war front, unfortunately, what happens in relation to wage negotiations, and how inflation expectations continue to stay anchored as they have re-anchored, some of the elements that we will be looking at very carefully in the job that we have to do to bring inflation back to 2% over the medium term. That's the same determination.
Yeah, Governor Bailey?
Well, I agree. I mean, like Christine, I am concerned about how the war front and the energy supply front is going to evolve. I think that is the major risk. I think, by the way, if I say, I mean, we had an inflation number out last week, and what I thought is that on the surface, it was pretty much in line with what we expected. Underneath the surface, there was a sign that we saw a shift in the makeup of inflation from the goods supply shock to the energy and food shock, which I would sort of characterize as the post-COVID supply chain shock, moving more sadly into the Russia-Ukraine world. And obviously we watch that very, very, very carefully as we go through the year. As we've said in our last monetary policy report, unfortunately, there is going to be a further step up in UK inflation later this year, because that's a product of the way the energy price cap in domestic energy prices are set based on the data that we've observed over the last few months, and we have to take that into account. But as Christine and Jay have said, the key for us is to bring inflation back down to target, and that's what we will do.
I mean, hindsight is a beautiful thing, I know, and I also know the ECB published a paper and saying, what you got wrong on inflation. But going forward, Mr. Carstens, how do we need to look at inflation differently? So, for example, in the US, and I'll ask the same to Chair Powell, the stimulus, did we miscalculate the impact this would have on inflation?
Can I just say one thing? I think it's a very healthy exercise to actually assess why you were off the mark. And, if all of you actually do the same exercise, you will probably realize for most of you that actually energy was vastly underestimated, and that, bottlenecks were also expected to clear much faster than everybody had expected. And I don't think the ECB is alone on that count. No. We're the first one to have acknowledged it publicly, but I think it's a good exercise.
No.
No, I mean, in the previous panel, for example, and if you look also into recent annual economic reports, you see that, for example, some very, very long-term held key components of the toolbox that we had to analyze inflation has not turned out to be so reliable. Like, for example, the traditional Phillips curve. That has been a workhorse for all of us. That, to some extent, kept, I would say, for some time, giving the indication that inflation could not rise that fast. We faced many limitations like that. I mean, I have to be very transparent. Last year, we tried to crank out some numbers of inflation, and we put them out there. And, here's one of the researchers that did the job, and he had a hard time cranking up higher numbers as much as he tried. And we had it at the end of the day wrong. And part of it, I mean, I'm not blaming it to him, it was my responsibility too. But that was the toolbox we had, Now we find that, there are many different hidden relationships or very key aspects about inflation expectations, expectation formations, situation in labor markets that can give you non-linearities, Therefore, we had a very nice model for normal circumstances, but as it has been said periodically here or in a reiterative fashion, turning points is what is very, very difficult. So we have entered into dynamics that are very different. So I think where there needs to be a lot of work is, and we started doing some of that job recently in the BIS, is to understand much better what is happening with inflation under the hood. Why some relative prices eventually become more contagious, to use that word, and start spreading around. Why some shocks are more perdurable than others. Why there are some prices that generate more spillovers. What determines the frequency of firms' revision of their prices, which certainly increases with inflation. The new technology that we have talked about, I mean, now we have Amazons and we have all these markets that probably were not there, certainly were not there when CPIs were calculated a few years ago. So there is a lot of things that we need to catch up. So I think it's a challenge for us. I think as we are accumulating all this information, I'm sure also will give us, and is giving already, more leading indicators of what inflation is doing, and that will be very, very helpful to calibrate a response. So yes, I mean, I think inflation will evolve. The inflationary pressures we're facing today are very different than the ones we had in the 70s, and I'm sure that the bout of inflation we might see in some decades forward will be also very, very different. So we need to preserve that nimbleness analytically to approach, and also be very mindful that we need the right instruments. And another thing that has been very useful is that the different central banks have been able to adapt their instruments to do monetary policy according to the circumstances.
But does everybody on the panel think they understand inflation better now than they did 4 or 5 months ago? Because you could also have, again, going back to Krugman's point.
Can I say something?
Yeah.
I mean, certainly I believe that we understand it a little bit better, not fully.
No.
There is a big, I won't say black box, but certainly gray box, where I think in the profession of economists we need to do better. No. And that's understanding aggregate supply. We are, at least I myself consider myself an economist that I was trained under the dominance of aggregate demand. And we know a lot how to aggregate demand responds to interest rates, how they respond to income, how monetary policy and fiscal policy has a transmission mechanism to aggregate demand. But we usually take aggregate supply as given. And it's very complex, it's very, very complex. And I think we need to understand far better aggregate supply. One confusion that is out there today, I think, is that the flexibility or the inelasticity of supply in the short term is there, but that doesn't necessarily makes it the same as a bottleneck. What is the difference? How impact that on inflation? So I think the understanding of aggregate supply that also includes labor markets is of the essence. So from the challenges we are taking forward, for me that is one that is very important.
I like the idea of a gray box.
In addition to aggregate sectorial supply, as we learned this morning with great interest, is also working.
Jay made a point earlier, and it's very important that we've had a series of supply shocks. This is the thing. I mean, the word transient has become discredited, but it isn't really in one sense, because that was built on a single supply shock idea. That supply shock can work its way through. The duration of that supply shock can often be shorter than the response of transmission response of monetary policy. Now, we've not been in that world. We've been in a world where we've had a series of supply shocks. I mean, look at our shocks. Yes, we had an initial demand shock from COVID, but then we had a supply shock with the supply chain recovery problems. We've had, obviously, a very serious supply shock coming from energy and the war. And we've had a labour market shock in the UK because the labour force has reduced in size. And it's, as Jay was saying, it's how you deal with a series of supply shocks, large supply shocks, with no air gap between them, which of course feeds through into expectations, because put them all together, they're not transitory in the traditional sense of the term.
Chair Powell?
One way to say it would be, I think we now understand better how little we understand about inflation.
That's not very reassuring.
No, honestly, this was unpredicted. I was looking at our at the time of our June meeting 1 year ago, of the 35 people who file with a survey of professional forecasters, 34 of them had inflation below 4% for last year. And of course, it was way above 4%. So really everyone had the same model, which was the Phillips curve model, and it just was not capable of producing high inflation. But what it was missing was something that's completely missing in the data for 40 years, which is basically a collapse of the supply side. You know, the U.S. economy is famously adaptable. You know, it has the minimum of structural rigidities, all that kind of thing. And yet here they are. So what you had was very strong demand, but hitting effectively a vertical supply curve. So ordinarily when people want to buy cars, which they really did because they didn't want to ride on public transportation, rates were low, they had all these savings, the car companies would make more cars, and they might raise prices too. In this case, they couldn't make as many cars. So what you got was straight up the vertical supply curve, a big price increase. But I also think, in principle at least, that process could work in reverse, so that as demand comes down, inflation could actually come down more quickly than would there are other relationships that people think about when they think about how do you get inflation down, which are more typical of a simply overheated economy and entrenched inflation, the sacrifice ratio and those kinds of things. But I think this could be, I don't know that it will be, but it could be different because it's just that process working in reverse potentially.
Do you see that process, President Lagarde working in reverse? So actually, I know it's different because of the proximity
what
to
we're
Russia.
seeing at the moment is more this swing or substitution that was described earlier in the day, where, because of COVID, everybody suddenly decided to stop using any kind of services, particularly if there was social distancing about it, and move to goods. Hence the car industry in the US and, stationary bicycle rather than the fitness club. And now we are seeing this sort of substitution back to services where people who've been deprived of restaurants, hotels, transportation, theaters, and all the rest of it, that side of it is currently booming and is sustaining the recovery that is otherwise under the various series of shock that Andrew was alluding to. So how these things are going to evolve in view of the uncertainty that we have in front of us here in Europe is something that really remains to be seen.
But how difficult, President Lagarde, is it to, for example, model a gas embargo from Russia?
It has proven, look, it has proven extremely difficult. And as we have seen from the sort of misunderstanding or wrong assessment that we have seen in the last couple of years, that is difficult for sure. And the rest is for the moment more in the scenario planning world than in the remodeling of what's going to happen on gas prices.
Mr. Carson, talking about emerging markets a little bit. So first, it's I don't know whether they're coming to their stride because they're used to the volatility, but there are huge implications, of course, of what the dollar is doing.
Yes, of course. I think at the end of the day, a very strong dollar implies for many of them very tight global financial conditions. And so far, again, as I mentioned, the exchange rate, the impact or pressure has been contained, but at the cost of very high rates. What is a little bit concerning, not that it couldn't be managed, but for some emerging markets, this is arriving at a time where there is high corporate debt and high sovereign debt. And therefore, some fiscal prudence is important at the time where emerging markets are facing still very severe challenges. Many of them haven't made as much progress with, for example, vaccination than in other countries. Also, for many of them, the impact of the increase in commodity prices, particularly in food and in energy, is very important. Usually commodities per se, foodstuffs and energy occupies a much larger proportion in their basket than in advanced economies. So that obviously reflects itself in more social need. And well, of course, many governments, according to their capacities, they are doing programs to assist people. So at the end of the day, they are on a tight situation. They have to manage things very prudently. I think if we compare this with other periods, emerging markets are better.